Okay, I have 11 o'clock in Perm, and it is 7 o'clock in Europe, and it is, I think, 11 o'clock in Arizona. Hello, Yuri. So we have a very, very international audience today. I hope both microphones are working. Okay, so this is the 9th International Conference on Applied Research in Economics and Finance. Unfortunately, this year again, we're holding this conference online. We hope very much that next year we will finally be able to gather together in Perm physically and see each other and communicate, because this is the whole purpose of the conference, ideally, so that people can speak to each other live. Today, the conference is in a very short, compact form. We are trying to give floor to everyone to present their papers, to advertise their research as much as possible. I will ask moderators of sessions to strictly watch the time so that the presentation is 15 minutes exactly. And if there are questions within the presentation, then it means that the speaker will have slightly less time to speak. But at the end of each session, there are 10 minutes in the program, and we will not turn off the channels. You can stay there, you can speak to each other, you are encouraged to do that, and ask questions and have discussions. I will also encourage everyone to use the chat facility on Zoom to write questions in the chat, and then the speaker can then read them after they finish their presentation, or if it is just a comment, for example, that doesn't need an immediate reaction, then write this comment in the chat and the speaker will read it afterwards, and you can discuss it during the break. One other minor thing that I wanted to draw attention to is that as in the last several years, we again partnering with the Journal of Industrial and Business Economics. The journal doesn't offer us a special issue for the conference. They do some special issues. As you can see, there is a special issue on industry dynamics and digital markets that is coming forward. But there is no special issue for our conference. What is there? There is an offer from the journal to do a very quick review of papers, given that they have been presented at this conference. And I am here at this conference. Former associate editors of the journals will also attend the conference, given that some people from the editorial board will be already aware of the papers that are presented here. This can accelerate the process of review for this journal. Just in case, if anyone is interested, feel free to contact me on the journal, and I can tell you what I may about the process for this journal. The journal has recently made it to the first quartile on Scopus, if it matters, and they have been selected for the emerging citation sources, which is the first step towards the Web of Science indexing. So the journal is progressing pretty well. So if you're interested in submitting your research there, contact me or submit and mention that you presented the paper at this conference. I don't want to be too long. The program says 5 minutes for the welcome speech. I welcome you all here. Unfortunately, online. I wish we could do it live. I wish you all a very good conference. The first session on Stream B will be chaired by Maria Molodchik, and I give you, Maria, the floor, and I will turn to my channel 1 and Stream A, and will chair the session on finance, where we have Yuri Tserlukevich from Arizona speaking. Yuri has the only person probably here who has a good evening yet. Everyone else already has a good morning, and Yuri has a good evening. So Maria, you have the floor. Yuri, you have the floor here. I'm very, very happy that you could make it to the conference. Thank you very much, and you should be able to share the screen.
Да, Дима, спасибо. Вы меня слышите?
Да. But we have the conference in English.
Okay. Yeah, English is perfect because my presentation is in English, and just want to say hi to everyone. I even forgot which year I was teaching in Perm, but I have the fondest memories.
I think it was about 7 years ago, maybe.
Yeah, I was teaching classes there. And, okay. All right. So I think I'm counting on about 15 minutes, and Dima, let me know when to stop.
Yes.
I didn't know the format, so I just piled those slides together on a recent topic.
Good.
So,
Okay.
So we've been working. I don't know if you know any of these people. Hendrik Bessenbinder has been working on risk management for a long time. He's at. So basically, okay. So slides. Fine. You see the shared screen, right? Okay.
Yes. Yeah, we do.
So we let me, in maybe 15 minutes, all I can do is just to give the brief motivation of what we did and maybe show a couple graphs. I worked in a modeling of corporate risk management. Risk management is just an official word for hedging, for buying derivatives, for example, swaps, so that you can reduce the risk of, for example, oil price if you're an oil producer, or the gasoline price if you're the truck driver, or the, for example, jet fuel if you're an airline. And this is kind of the product of us directly looking in the data and trying to understand if theory holds in the data. And turns out to be that it doesn't hold. The theory prescribes, and I'll show you maybe some of the most famous papers in the risk management and hedging. Theory prescribes some kind of, if I can explain, some kind of trade-off. So the theory would say, well, hedging or risk management is costly. There are costs of getting in position, there are collateral constraints, there are explicit costs, there are fixed costs. Now, hedging is also beneficial because it can provide firm with smoother taxation, with easier way to contract with its suppliers, with a smoother income as well that allows them for more proper capital structure, higher leverage, more tax benefits. So all of this was exploited on different theoretical empirical level. But the bottom line is this: when I look through all these millions of papers that were written in risk management, they essentially state that risk management has a value. And as to prescription, what risk management should be, they provide some trade-offs that eventually gets to the point that, well, if for example, if derivatives are cheaper, then the hedging should be more effective. Or if derivatives are more expensive, then hedging should be smaller. Or if firms are risky, then we should hedge more. And eventually they derive some optimal. So long story short, this paper that I'm going to talk very briefly about states that there is no optimal hedging just because the firms are constrained about what they can do. So we hand collect sample of firms that are oil producers and gas producers in the United States, and we track very carefully the hedging portfolios, and we find that the hedging portfolios, the risk management, is effectively bounded by the lending agreement, that is by agreement between them and the banks on lending the money. Those lending agreements specify the minimum and maximum amount of hedging that firms can do, and the firms have to kind of stay within these boundaries. So this hedging, those boundaries effectively explain why firms hedge much more than they used to be before. So now we get to another point. How do you know that this comes from the banks? Well, first of all, we've looked at the statements. We know from the bank statement that banks require firms to hedge. And second, we use the change in technology, exogenous shock, to identify the effect. So in you may be familiar with fracking or even with fracking literature. Fracking is technology that in a combination of horizontal drilling and fracturing of the stone to extract oil and gas much more effectively. So this technology was implemented on much larger scale around 2008, 2009. Let me show the picture. So this is from our sample. You can see that the frequency on the left side of the word horizontal, standing for horizontal drilling, in our sample jumps from almost 0 to about 15 per farm in around 2010. And the frequency of the word hydraulic, that stands for hydraulic fracturing, jumps around the year 2010. That's when the firm started using the technology. Why is this important? Let me skip the slide. Well, that's because it immediately translates, not immediately, but quickly translates into higher production of oil and gas. You see the oil production on the left, and it increased basically in our sample of oil producing firms from 5 to 25, sometimes up to 5 times. And production of natural gas jumped from 4 to 14, about 3 times. So that's kind of the reason, if you, especially in Russia now, if you're wondering why the gas prices were so low over time, this was one of the reasons, because there was a lot of gas produced in, with new technology, not only in the United States, in many countries. Okay, but why is this important? That's because to make this possible, to make the fracturing technology implemented on the field, the large capital expenditure was necessary. Capital expenditures changed from the average per firm about 200 million to 1.5 billion. And those large capital expenditures were put into drilling and production of buying the land and buying the components for technology. Okay, why is this important? Well, that's because this graph is mirrored by the debt and equity issuance. So again, looking at this graph for investment, we shift into the graph for debt and equity. You can see that almost all of this increase in capital expenditure was financed with debt, the red bar, as opposed to blue bar equity. So why debt, you might ask? Well, that's for 2 reasons. First of all, the oil prices were very high, so it was easier to borrow against them. And second, the interest rates were very low, so it was natural to use debt instead of equity. Well, why is this important? And that's finally because, here we come, that's because firms suddenly increased the amount of debt many times, and with this debt, they received new lending agreements with the covenants, because they were much more risky, and those covenants require them to hedge. So that's basically, this picture more or less summarizes the paper. The firms that experienced change in technology, they to increase production, they had to invest much more in drilling. To invest in drilling, they issued much more debt around 2008, 2010. And as they were issuing debt, because of the covenants that required them to hedge the production, to obtain those loans, the hedging changed dramatically. For example, for oil hedge ratio, that's a hedge of exposure to oil, changed from about 20% all the way to 40% in our sample in just a couple of years. And oil and maturity of the oil contracts, that is how long the contract is valid, changed from just 5 months to about 15 months. Okay. So I'm going to use my last couple of minutes, because it's a short presentation, just to show you how it works. So when the firms borrow, and I can just give you a couple of examples, when the firm borrow from the bank, at least in our sample of oil and gas producers, they receive the covenants, the hedging covenants, that say something like this. The company is required to hedge at least 50%, but no more than 75%. It works simply that the bank would like to hedge some of the risk, the lower tail, to make sure that the firm does not default and repays the loan, but it does not want it to hedge too much, because over-hedging is almost synonymous with taking risks. Buying too many derivatives means actually increasing risk, the risk shifting instead of hedging. So this type of covenant that's present in most of the agreements explains why firms are entering through master's agreement into hedging agreements, and those hedging agreements persist all the way until bankruptcy. So that's about it. So, okay. So here's one last slide that I wanted to show you before kind of concluding the overview of the paper is that those agreements that drive hedging very much depend on the type of the bank. I didn't get to European data, so some of you may suggest how it looks in Europe. In American data, the banks, the large old banks, for example, JP Morgan, is very highly likely to include any kind of hedging covenants. And in 50% of the cases, they require covenants explicitly requiring hedging into the agreement. Wells Fargo does it for almost all firms, but some banks, such as French BNP Paribas, only includes it in about 30%. So, I'm sorry, yeah, I'm consistent, is not Bank of America, I meant. Yeah, here we go. So why some banks require hedging? together with the agreement and some do not, we don't fully understand. This kind of next steps that we're trying to do. Okay, so I still have a couple minutes, right?
You have about 5 minutes.
Especially it's about midnight here, so it's a little surreal. Okay, so all right. Now let me show you, since I have a couple of minutes, let me show you the overview how these covenants look in a sample. I think, yeah, this slide that I would like to talk about. So across the firms, we see that majority of the firms through different types of agreements, they have a requirement to hedge. So I'll draw your attention to the minimum and maximum. So minimum maturity by month is between 26 and maximum 46 months. So remember, at the beginning of the sample, before the fracking revolution, firms were hedging about 5 months in maturity into kind of half of the year. And then you saw how the maturity shifts to like all the way to 40 months. And that what you see here on slide is exactly explaining this. So with the minimum maturity of hedging 26 months required by the bank and maximum 46, and of course, firms start hedging for much longer horizons. Look at the hedge ratio. So hedge ratio is a proportion of the oil output or gas output that is covered by the, for example, swaps. So this minimum hedge ratio in the sample, if the agreement includes hedging covenant, is 54% and maximum is 82. So again, remember the hedge ratios were about 15% before the firms entered the agreement, and then they jumped all the way to 50. So this also explains why they jumped. So the final interesting thing that we kind of work on separately is covenants that require to report the hedge positions to the lender and require sometimes to hedge with the lender. So we found it extremely strange. For those in the banking literature, you'll find it interesting. We found that not only the firms are required to hedge, they often required to hedge with a subsidiary of the same bank. So for example, Wells Fargo is issuing loan, and strangely enough, Wells Fargo says you can hedge this loan, you can remove risk to facilitate the Wells Fargo borrowing, but you will have to hedge with the Wells Fargo hedging division. So kind of you would have to hedge to protect me from risk, but you have to hedge with me. We found it we found some reasons why they do it, but it goes against agency series that we saw before. Okay, I don't want to run over time. I'm worried about transition, but let me know if you have any questions.
Do you intend to show more results now?
As you like. I think that
it's just you mentioned how banks force their customers to hedge with the bank's subsidiaries. It reminded me the securitization process when the banks issue when the banks organize a company that actually buys debt from the bank, but this company belongs to the bank itself. So it looks like this is an artificial creation of a visibly or similar situation to, okay, we have something good, we have everything hedged, but in fact it is not. In fact, the risk is still with the bank. So it's right. It just reminds me similarity. So maybe the reasons in securitization and here could be similar.
I see. So since you mentioned, since you're saying I still have a minute, so here's the example on my slides of such requirement. So this is Meridian Resource, large oil company. It's 10K, its annual statement. The company says that the company's credit facility, which is a lending agreement, the loan, requires that counterparties in derivative transaction be limited to the lenders, including affiliates of the lender. Yeah. So there is on the lending agreement there will be group of lenders. So it's a syndicate. And the main lender would require that the company only hedges with the lender itself, with those listed on a banking syndicate, or with the affiliates, and nobody else. So they want to have full control, even if it means more risk.
Yeah, it looks like they want to have full control. It's 20 minutes past. I have to interrupt you here. I will welcome questions to Yuri to be either put in the chat and then we can take a copy of them and send them to Yuri.
Yeah, or send by email if you'd like. And
or send by email. I wish you good night. Thank you very much for joining us.
Yeah, I'll stay a couple more minutes just to see the other presentations, and thanks for inviting.
If you stop
in person next time, right?
Yes, hopefully. If you stop sharing your screen, then the next speaker is Dmitry Kirpishikov. And Dmitry, you should be able then to...
Give me a sec.
It should be on the bottom of your screen. The button.
Okay.
Yeah, now Dmitry, you can share.
Do you see it?
Yes, we can see it.
Well, good morning or good afternoon. I would like to present the preliminary results of our joint work with Yuri and Marina Zavityaeva. In this paper, we analyze the effect of economic policy uncertainty on corporate investments. And we also try to take into account the smooth effect of company social capital. Let's start with some motivation of this research. Corporate investments, both in intangible and tangible assets, are crucial for corporate development. However, such investments are highly sensitive to uncertainty. Therefore, macroeconomic and political instability decreases the incentives of companies to invest because the risks increases. Well, the literature posits the pricing effect of uncertainty on tangible and intangible investments. And we know that companies should make some investments constantly. And the question becomes important: which instrument or mechanism allow companies to be more stable in time of uncertainty? And one of the possible mechanisms is to look at corporate governance system of companies, and especially on board of directors, since boards can improve the internal control within companies and therefore reduce the influence of external instability. Also, they may provide some additional resources for companies. We in this research consider one of the characteristics of boards, namely social capital. And the research question can be formulated as follows: is it possible to use social capital brought by board of directors, to decrease the influence of certainty on corporate tangible and intangible investments in Russian companies? From the point of literature, theoretically, the uncertainty decreases the risks and decreases the investments, of course. And the core theory here is real options effect. This theory assumes that under high uncertainty, a firm has incentives to delay their partially irreversible investments if possible. Okay, they tend to delay the investments, and how empirical papers can measure the uncertainty. It's a hard question. Some papers use uncertainty on financial markets or some firm-specific uncertainty. There is also the index of economic policy uncertainty proposed by Baker, Bloom, and Davis. Overall, in the literature, there is a confirmation of the negative influence of uncertainty on corporate investments. And how can we deal with uncertainty? We can look at the people who rule the company, especially the board of directors, because both qualities may smooth the effect of uncertainty. it is shown that boards adjust their structure, for example, size, as a response to higher uncertainty. Moreover, some skills and some expertise of directors become more important during the uncertainty. So we want to look at one of the characteristics of board of directors, namely social capital. It can be defined as benefits that individuals, in our case, directors, are able to extract from their social structures and memberships. So we assume that connections which a director has can gain him or her some valuable information which can decrease the effect of uncertainty. And in this research, we consider 3 types of connections. The first is professional connections. For example, if 2 directors work on one board at the same time, they will be connected, and they share their information, their experience during their work. So there are some mixed empirical results about the impact of such professionally connected directors on the company's performance. But as for developing markets, there are some positive evidences that professionally connected directors have positive influence on corporate performance. Okay. The second is international connections. It is assumed that such directors may provide international experience to companies, so they provide better monitoring, for example, and they can even provide additional resources. For example, they can provide access to international markets, and it is a valuable source of resources for companies on developing markets. And the third is political connections. It is assumed that such directors are familiar with governmental bodies, and they know people who work there. Probably they can be familiar with forthcoming legal changes, so they can reduce the effect of political instability, for example, and they can even bring some additional resources from the government to their companies. And our hypothesis can be drawn as follows. In general, we think that all these type of connections will be positive, moderate the relationship between economic policy uncertainty and in corporate investments. We analyze largest Russian companies, which shares include in Moscow Exchange Broad Market Index. Therefore, we take into account companies that contain approximately 18% of total Russian market capitalization. It's our source of information in the slide, and how we measure the uncertainty. Actually, we didn't measure it. We take the information from Baker, Bloom, and Davis website. They calculated this index for several countries. In case of Russia, this index calculated based on the newspaper Kommersant. And this are our 2 equation models. The first for tangible assets, which we calculated as capital expenditures, and the second for intangible investments, calculated as research and development. And as for social capital, we use for international connections and political connections dummy variables. At the same time, we separately look at directors with international working experience and foreign directors. As for professional connections, we calculate the metrics of centrality, which based on the social network analysis, the intuition, how we can get to these centralities below their names. Well,
Dmitry, you have 5 minutes.
Okay. This is the list of our control variables. We also include the variable about sanctions dummy, and we take into account the ownership structure.
Just to clarify, do you mean the sanctions against the government or the sanctions against the individuals on the board? So sanctions individuals
against the company, I guess.
Against the company. Okay.
Probably. Yeah. Okay. And these huge tables with our results. This is results for the first question, where we use as dependent variable capital expenditures. Also here we include all control variables and estimate this model using generalized method of moments. So we find the negative effect of economic policy uncertainty on capital expenditures, and we find the positive moderating effect of presence of directors with foreign experience, and the negative one for the degree centrality mean the number of professional connections. Also, we try to include these variables all together. Here may arise some problems with estimations, but still in this setup, we find the positive moderating effect of foreign experience, political connections, and the eigenvector. That is the importance of directors whose director have connection. So the importance of my colleague, and the negative one for the number of connections. The second table for the second question, and where we use research and development as a dependent variable. Here we cannot provide so significant results, and we also find the negative effect of economic policy uncertainty, and only in case when we include all these variables in one equation, in one model, we find some moderating effect of, for example, degree centrality and negative effect of closing centrality. So the number of connections is positive, the number of professional connections of directors is positive moderate, these relationships. And the speed which that characterize the information obtained is negative. So here the try to summarize all results. So we find the negative influence of economic policy uncertainty on both kinds of investments in Russian companies, and this result is consistent with the literature. Also, I think we find some moderating effect of social capital on this relationship. And that's all. Thank you for your attention, and I would like to answer your question lately. Probably my colleague also will help me.
Thank you very much. We have about 1 minute remaining if there are any questions.
Okay.
Okay, just a brief comment. I think this is a very interesting paper. I'm very interested in economic policy uncertainty. It would be, that's why I was asking about sanctions. and maybe I should look into the paper to understand better how sanctions, what is the relationship between them, and whether you can measure somehow the uncertainty about sanctions, because it's not only sanctions that have been introduced, but also the danger that the sanctions can be introduced on the company, and if that might have any effect. But I will stop now the discussion because we have already 35 past 11 in Perm, and I would like to give a floor to Vyacheslav Manevich.
Yes.
Who is here, and you can share the screen. Oh, that's not cryptocurrency. This is cryptocurrency. Okay, the floor is yours.
Yes, my name is Manevich Vyacheslav. I am a student of High School of Economics in Moscow, and my work cryptocurrency market volatility. Subject of my article to investigate the internal relationships between different cryptocurrencies, as well as the futures of the stock index, by extracting and analyzing the global component from the time series and question and further studying is objectives extracting of a global stochastic trend for the three cryptocurrencies, a study of the global general trend to understand internal inter-cryptocurrency dependencies, study of extracted global trends for each cryptocurrency in order to study the exposure of a particular cryptocurrency to global trends, extraction of a global stochastic trend between Bitcoin and the S&P mini index futures, and extractions the connection between the cryptocurrency market and the financial market. Методы лучше. In my work, I used the Kalman procedure is applied to a random walk model to extract the global stochastic trend. This relative volatility, where its profitability and PTG is a price at day T interval G for the process, for three processes in this formula, and for two processes in this formula. The alpha and beta parameters and the variance V are estimated using the maximum likelihood method. W has variance equal to 1. Data in this interval, and Bitcoin, Ethereum, Litecoin, and mini S&P 500. Bitcoin is the world's first most capitalized currency, is the main cryptocurrency, and its behavior can largely help predict the behavior of altcoins as Ethereum and Litecoin. And its cryptocurrency trades all week. Ethereum is the second most capitalized. In some aspects, the behavior of Ethereum resembles the behavior of the stock price in the stock markets, and it's traded all week. And Litecoin is the 8th most capitalized and the fork of Bitcoin. Fork is double, is less dependent of hardware and has a much larger number of coins, and it's traded all week. And futures S&P is a futures contract traded on the Chicago Mercantile Exchange, representing 1/5 of the value of standard S&P index futures contract. And this active trades almost all week with small breaks. The rates themselves and the logarithm on their daily realized volatility, calculated on 5-minute intervals, are considered as the process on the study. Since some futures and Bitcoin trading intervals don't coincide, there was a need to synchronize data, so some of the data was deleted because S&P have a gap of trading. The global trend is allocated both in a static interval and in a smoothing window. Cryptocurrency, if we disregard the issue of orders of magnitude in this slide, they have similar and moments of large declines increases coincide. And for logarithm, for relative volatilities, There are high values and oscillation for Litecoin, repeating the not so strong fluctuation of Bitcoin. And this slide, static window 2 year for rate. The slide shows the variance ratio of the extracting global component and the variance of the initial data. For Bitcoin and Ethereum, this value in about 0.3, and the global trend explains the process under study by 1/3. At the same time, for Litecoin, this ratio is slightly more than 1. And also, estimates is significant, except for alpha 1. In 2018, Bitcoin is characterized by an overestimating value of the global trend. Then the Bitcoin rate is almost completely determined by the global component, which may be due to the relativity calm period for Bitcoin itself, which then turns into a lowering value of the global trend and greater positive influence of the internal local component. The global trend for Litecoin is almost identical, well, for Ethereum is almost identical to the rate of Litecoin. For the realized volatilities, the ratio of variance of extracted global component and variance of the initial data for Bitcoin and Ethereum is more than 0.5, while for Litecoin it's only 0.3, and the estimates of the all parameters are significant. Realized volatilities of Bitcoin is largely due to the global component, except for the peaks, which can be attributed to the outliers explained by the local component, some internal structure shifts and changes. The global trend here isn't so significant, and quite a large share of the process can be explained by the global component and some internal noise, as well as the fact this cryptocurrency has fewer holders and trades less. Its estimates in static windows 2 year for realized volatilities of Bitcoin and futures. All estimates are significant, but the ratio is only this value for logarithm of realized volatilities Bitcoin, and this value is for S&P. This suggests that there is only a weak relationship between the two. For the logarithm of Bitcoin realized volatilities, the influence of the global component is not great when considering it's extracted together with the futures, and exactly the same situation is observed for the futures, except with a shift downwards. The fraction in this case is the average ratio of variance of the global component to the data failing is a sliding window. This is some analogy of the previously considered ratio. For Bitcoin and Litecoin, the share of the global component for the logarithm of realized volatility in the sliding window is 10% higher than for static intervals of 2 year. At the same time, for Ethereum, this difference is slightly less than 5%. In moments of the surges and fluctuations, the behavior of the share of global component is similar and makes it possible to trace the general trend of decline or growth, while in more calm periods it might differ. This is smoothing windows 2 months and step 1 day for logarithm realized volatilities of Bitcoin and futures in S&P. The average values are close to those obtained for the static windows of 2 year, but for Bitcoin, in this case, the share increases with decreasing step and slightly exceeded the value obtained for the static windows, while for futures, in this case, the average values in lower than for the static interval and decreases with increasing step. This can be explained by the fact that the consideration of the model in the sliding windows is a small step, but allow taking into account for microstructure, features inherent, and the processes under study. The graphs of the share of the global component for the logarithm of the realized volatility of futures in Bitcoin are significantly different. Also, some general trend regarding growth or decline can be seen. They are noticeable only in the moment of sharp drops, so we can speak about the influence of global component on the true processes is not very close. Conclusion and results of my work. Despite the fact that Ethereum had slightly different principles of operations than Bitcoin, the behavior of the rates and the realized volatility are similar in many ways. Also, Litecoin is a fork of Bitcoin, and its rate, the paradigm in question, is largely explained by the global component, which can be taken as the influence of Bitcoin. Other processes based on Litecoin rate, first, are more volatile, have more oscillation, and second, was explained by the global component, especially in 2020. Also, in general, the global component for Bitcoin and futures is weakly expressed. We cannot but note some visual and structure similarity of the extracted trend, which indicates a connection between the two values, but quite weak. And global stochastic trend was extracted from a future of exchange index in Bitcoin, a major cryptocurrency. In future studies, further analysis of the relationship between cryptocurrency and the stock indices is planned. And it's all, it's references. Thank you for your attention.
Thank you very much. We have about 3 minutes for questions, if there are any questions from the floor. Because I do have some questions, but I don't want to jump ahead anyone else. Okay, if nobody is willing to ask a question at the moment, you can always email Vyacheslav later when you have questions. On my side, I find it really interesting to look into different cryptocurrencies. I should say that I didn't quite understand from the very beginning what the global trend was in your study. I understand that this is some sort of commonality between movements in one asset and the other asset. But from all the evidence that you have provided, I would like to understand, well, first of all, remarkable is that the Litecoin, which is sort of a derivation from Bitcoin, has little to do with Bitcoin itself. So it sort of behaves in the market in its own way. And the second thing is that the futures index also doesn't really co-move with the Bitcoin price. So based on that, can we infer some implications about the fundamental value of cryptocurrencies? Does it exist? Or it looks like Litecoin should have a fundamental value based on Bitcoin, but it doesn't work. What is your impression from the data that you have analyzed?
Очень извиняюсь, у меня некоторые проблемы с именно пониманием устной речи. Если коллеги не возражают, можно повторить то же самое, только...
I will translate in Russian and then I will translate. Yes. Что можно сказать о фундаментальной стоимости? Вот ваши результаты, которые показывают, что к глобальному тренду не очень сильная привязка, и привязка биткоина к фьючерсам как бы не сильно прослеживается, насколько я понял. И Litecoin не сильно привязан к биткоину. Можно ли из этого делать вывод, что они скорее движутся в силу поведенческих, каких-то психологических факторов на рынке? Или же можно говорить, что какие-то признаки наличия фундаментальной стоимости существуют?
В целом, вот именно эта работа является отправной точкой для дальнейших исследований, и она показала, что на момент до 2020 года биткоин действительно больше подвержен некоторым поведенческим факторам, нежели фундаментальным. И многие исследования показывают, что до 2020 до 2021 года биткоин все еще является незрелым рынком, который не подчиняется, скажем так, стандартным базовым рыночным законам, как тот же индекс. Сейчас в процессе написания несколько работ у нас. Во-первых, исследование влияния Google трендов, то есть упоминание биткоина на его стоимость. Это раз. И во-вторых, причинность между биткоином.
Да, я понял. То есть вы исследуете дальше. Я сейчас быстро переведу, и мы должны следующий доклад. A quick translation is that up to 2020, we do indeed observe that the Bitcoin price and other cryptocurrencies are to a larger extent moved by behavioral factors, and there is little evidence in favor of existence of some fundamental pricing effects in these markets. And I have to stop here the discussion of the very interesting discussion for me of cryptocurrency market, but I'm sure that Oliver Bakuka will also present another very interesting paper. Oliver, the floor is yours, and you can share your screen.
Okay.
Thank you for joining us.
Thank you for the floor. I want to share my screen, so just a little bit.
It should be in the bottom of your screen, the green button, share screen. And you can choose which part of your screen you would like to share.
Yeah. So 1 minute. I think that. Can you see my screen now?
We can see your screen, but we also see some folders that you probably didn't intend to show. We can see the program and the folder security features.
I want to.
So you probably are showing a different screen.
Okay. So.
Yeah, now we can see the presentation.
Okay. So thank you for the flow. My paper analyzes stock selection in emerging stock markets and empirical analysis on the East African Securities Exchange markets. So the plan of the presentation, I will introduce, speak about motivation, objective paper, and the contribution of the study. After, I will talk about methodology, present result and analysis. And by the end, I will conclude. So in the past decades, we observed significant and remarkable expansion in emerging financial markets, surge of stock market from African countries, and the market capitalization increased nightfall, more than 2,000 firms listed. So existing studies on emerging stock markets examine individual and institutional stock markets. And those studies conclude that stock selection strategies that perform well in developed markets likely generate significant outperformance in emerging markets. Here on the graph, you can see some markets in Africa. So our attention has been captured on emerging markets, especially on the East African markets. We took into account free markets, from Nairobi, Uganda, and Dar es Salaam into three countries. And some firms are cross-listed on many East African stock market for financial flexibility and promote market liquidity for shareholders' benefit. So the three markets that we took into account are particularly challenging market for stock selection in the East African security market. So the question is to find active strategy by selecting stock for which an high return is expected related to the estimated risk premium. The objective of the studies is so that this paper is to select stock and construct portfolio that enable to outperform the benchmark in the East African security using Farman-French three-factor model, comparing country-specific model, global one, and international model. The period is from 2011 to 2019, and to test farm and French model 3-factor on through East African security markets. Unlike some prior studies focused on just one East African market. And our study will find whether statistically and economically significant abnormal return in the select portfolio are compared with the benchmark. For the methodology, the data used all the firms listed on the 3 markets retained in our studies. And for international model and world model, we will consider only 7 firms primarily listed on Nairobi Stock Exchange and cross-listed on Uganda Stock Exchange. We came from the semantic excess return function from CAPM, and after we extend it to farm and French model by adding 2 more variables to account both size and markets to book both size and value risk factor premium. And then after the farm and French domestic model is extended in a global and international context as below. So we will proceed by regression of portfolio excess returns by regression of OLS. For comparing our portfolio to the benchmark, we use a t-test to test the nil hypothesis. So here are our variables. We choose those variables by sorting the size by median and the book market equity by 13th and 17th percentiles. So for our results, must not run over time. I will be I will present the main results. The main result is that our model of the model of CAPM doesn't fit our sample, so we try to test the farm and French that fit very well our sample by each portfolio. And then in the region, we try to test domestic, international, and world factor, and to test integration versus segmentation. And by the end, we found that even those markets are not integrated, but there are incitation to integrate those markets, because it can be benefit for investors, and there is a roadmap to arrive to integration, and that will be interesting. But for our samples, just we found out there is just segmentation who fit our database. So by concluding, I will say that portfolio outperformed the benchmark using farm and French to 3 East African stock markets. To select stock that outperform benchmark, farm and French 3-factor domestic model is useful to these markets in an active portfolio management. Model farm and French performed than CAPM using OLS. We found significant betas. Additional risk factor improve H2 and relevant stocks portfolio excess return explication. By the end, stock portfolio with course listing stocks constituents does not improve portfolio excess return. Thanks for your attention.
Thank you very much. Very quick, punctual presentation. We have about 5 minutes before we start break. Any questions to Oliver on this application of FAME in French to East Africa. Did really the African market start really so recently? Because I thought that there was more. Which year was the start year of the African market?
There is many markets who start from 1950.
1950, yeah, but
yeah. So from my research, I have the old market is the market from Kenya,
yeah,
followed by the market of Dar es Salaam and Uganda, but those markets are still emerging.
Yeah, of course, because the number of companies there is not comparable to what they have in Europe or
in USA and other countries or other.
But that's what's puzzling. That FAME. Well, I'm not surprised that CAPM doesn't work. I mean, CAPM is a theoretical abstraction to demonstrate that if the world was so ideal, then this is what you have to obtain. But we know that the world is not that ideal. What is more surprising is that FAME in French works so well for the African market, because FAME French was rather developed for larger markets. It requires quite a decent degree of non-arbitrage and quite a decent degree of ability to diversify through other stocks. It looks like that even in a smaller and the market that I would expect to be less efficient, it still works. That's do you have any explanation for that?
Is that according to what you are explaining? When we compare developed markets to emerging, we found that developed markets have more explication for anomalies determining excess return, but we can try on emerging markets and see if it can works and improve CAPM. Because what we see over emerging is that those markets are still on a basic development. So we can try to replicate what some strategy used in developed market and see if it can be more profitable on emerging markets.
It's quite illuminating. Thank you very much.
Yeah.
If there are no further questions, then I would call a break and we will restart
Dmitry, I have a question.
Yes, please.
Thank you for your presentation.
Thank you.
It's quite interesting. And I have two questions. And the first, why do you consider a 3FF model rather than, for example, 5FF or 4FF by Parhams?
For my paper, I just begin by testing three models, FAME French three models, because from my database, I didn't have enough information about profitability or investment that extends 3 factors to 5 factors. So I just test the free model, and in the future research, I can try to develop my database and have information about investment and profitable to consider 5-factor models.
Okay, and the second question is, you construct the 6 portfolios on each year, right?
Yeah, 6 portfolios.
Probably you could construct 4 portfolios, so you can use the breakpoints on median by size and value. So since you have a little number of companies in your data sets, maybe it can improve your results, for example, right now.
So according to your question, I consider 6 portfolio because I consider the medium percentiles. So if I must consider for portfolio is that I must cancel the medium value. If
What you want.
Yeah. So
Okay.
it will be two portfolio, two sorting multiplied by two sorting from size multiplied by two sorting from value. Yeah.
Okay. Thank you.
Thank you.
Okay, thank you very much. Then it is time for a break. We will gather here again on this channel in 10 minutes. It will be 12:15 Perm time, and the session chair for financial institutions will be Peter Parshakov. And now just use the time for, well, whoever wants to have a discussion here, the floor is open for everyone. You can have a chat here, or just use the time to have some fresh air and then return for another 3 interesting presentations later. See you later.
Thank you.
Oh, okay. I should click OK. So it's still work in progress, and your comments are really welcome. So the motivation for this study is quite straightforward. As you might know, the formal information sharing, meaning credit bureaus and credit registries, is now introduced in the most of the countries in the world. According to the latest data from the World Bank Doing Business project, almost 90% of the countries introduced this or that or both types of the information intermediaries. But what varies much from country to country is the quality, the depth of the information collected by the information intermediaries. So just to give you a very brief snapshot, here is the index of the depth of the credit information. And it indeed varies from 0 to 8 by calculations, and the number of countries where the depth of the information is at a very low level is really high, almost 20%. And only half of the countries introduced a very deep information sharing systems. Here they are at the level of 7 or 8. So the natural question arises here, is it, why is so? Is it always better to disclose as much information about the borrowers or potential borrowers as possible? So is it always associated with the credit risk reduction? This is the main goal of introduction of the information sharing system in the credit market. And quite surprisingly, the literature does not provide a very, very evident answer to this question. So, of course, there are plenty of papers, both theoretical and empirical, showing that there is some positive, some number of positive effects of the information sharing in the credit markets. Of course, it reduces the information asymmetry, providing additional information about the borrowers. It even prevents from the over-indebtedness for some countries. Of course, it allows estimating more correctly the credit risks of the borrowers. That's why the scoring models predicting power is increased. It also stimulates the competition among banks because it dilutes the information rent the banks may enjoy. And for some cases, for some countries, there is some evidence that it improves also the access to credit. But what is important for us within this particular study is the disciplinary effect which is ensured by the information sharing. This means, to put it simply, that the borrowers who know that their credit history is collected and will be available for the potential lenders may be more accurate in repaying the credit, may employ more efforts to do it in full, including all the interest. In the same time, there are some reasons why it can work in some different way, in the opposite way, to be precise. First of all, the first reason why this disciplinary effect may be diminished, may be diluted, is that if we disclose much of the information about the borrower, this means that the fact of the default is not anymore the signal of the quality of the borrower. This means the borrowers may imply less efforts to repay the loan in this particular story. The second reason is related to the credit ratings. If the borrower knows that the default will somehow and maybe significantly influence the future credit rating, he or she may decide just to perform the strategic default. And finally, if the longer credit history is collected, and this is one of the dimensions of the depth of the credit information index, if the longer credit history is collected, this means that each particular default has a smaller influence for the decisions of the potential lenders of these particular borrowers. All this taken together makes us think that there may exist sort of a nonlinear effect, nonlinear relationship between the depth of the credit information and credit risks. Just to check this hypothesis, we estimate quite a simple type of the regression. So here on the, yes, we use the country level data starting from 2004 and ending in 2015 using the blendable GMM estimators. Here on the left-hand side, we have quite, again, traditional measure of credit risks, which is the share of non-performing loans in total loans, meaning the loans overdue over 90 days. And what is the most interesting for us, the variable on the right-hand side, is this particular World Bank Doing Business index of the depth of the credit information. It is calculated quite straightforwardly. It adds 1 if we have the positive answer of the following questions. So we add 1 if the data on both firms and individuals is collected by the information and sharing system of the country. Then if both positive and negative information, meaning the information about defaults, accompanied with the additional information like financial statements, the income, something which is not related to the default is collected. Then if not only the data from the financial institutions is also collected in the credit profiles, if the historical data is quite long, at least 2 years or even longer, if the threshold after which the loan gets into the database of the information intermediary is quite low, mainly below 1% of the income per capita in the country. If by law the borrowers have the right to access their data, at least in the largest information intermediary in the country, then if banks and other financial institutions have also online access to the credit information, and finally, if the information intermediaries offer as an add-on service the ratings calculated by the credit bureaus or credit registries. The problem with this data is that the last 2 points are available only after 2012, not available, but were introduced by the World Bank Doing Business surveys. That's why we cannot put this variable directly as a continuous variable into our regressions, and we introduced 2 dummies controlling for the first and the second period, before 2012 and after that. And just to focus on the couple of variables of our main interest, let me show the following multiplied variables. We have the squared terms for both of those information sharing index, and that's how we are trying to capture the nonlinearity in our model. And of course, we introduce a set of controls, quite traditional controls of these type of studies. We introduce the variables characterizing the banking sector of the country, controlling for its size, concentration, profitability, activities diversification. Somehow we control for the efficiency and the participation of foreign banks in the market. We also control for the macroeconomic situation in the country, introducing the GDP per capita, inflation, rule of law. Of course, those are quite highly correlated, so we introduce it after the PCA analysis, the principal component analysis. And we also include the exchange rate and lending rate. The last 2 somehow reduce our sample because the data is not available for all the countries in our study. So here are the sources of the data we use, in addition to the Doing Business project, which is as far as I know, now closed by the World Bank. We also use another 3 World Bank databases. These are the World Development Indicators database, the Global Financial Development, and Worldwide Governance Indicators. And we estimate one by one the following line of models just to check for the stability of our results. The first one is the simplest one. It includes no year fixed effects. Then we add those year fixed effects. Then we also introduce the foreign bank share in the market, and then we introduce the exchange rate and lending rate in the country, because once again, those to reduce our main sample. And here is the set of our results we have so far. These are the results for the main 4 models estimation. We basically show that, just to show it on a picture that's very evident here, indeed we observe quite stably across the modifications, especially for the first period of our study. We observe the nonlinear relationship between the depth of the information sharing index and the credit risks measured by the share of non-performing loans. And our results show that there is a positive relationship between those before the depth of credit information is somewhere in the middle at the level of 3 or 4. And only after that we observe the expected, at least by the regulators, the expected effect of the reduction of the share of non-performing loans with deeper information collected by the information asymmetry. This means that we observe, at least at the low levels of the depth of credit information, the declining of the disciplinary effect, which is not compensated by some other positive effects of additional information disclosure. And after that, we wondered, these are the effects of bank controls. I will skip that for the lack of the time. We wondered also what can influence the relationship between those two, because of course the economies covered by our study are very different, both developed and developing markets, even transition economies. So it seems that markets may be different, at least to some respect. So what we did, we looked at the differences, first of all, related to the overall quality of institutions in the economy. Then we look at the private property protection, which is more close to the question we are focusing on. And then we looked at the different degree of the financial market development. Here I list the variables we are using to control for that. And what we do, we separate our sample to 2 subsamples by the mean of those listed variables here. And we re-estimate our equations on each separate subsample. And just to show you briefly the results that we have, they are very similar. Or whatever measure of institutional quality and financial development we use, we see that this effect, the negative effect of the information sharing and information sharing on the credit risks appears quite immediately if we see good quality of the institutions in the country. If we see property rights protected quite well, here is the figure again. And if we look at the financial institutions development, we see it even more evidently. So you can see that for the less developed countries, it is even almost not possible to receive this positive effect between the stability and information disclosure index. So here the threshold is over there, above 8, the maximum degree of information sharing. So just to conclude and to highlight the main findings we have so far, indeed, we observed a nonlinear relationship between the degree of information sharing and the quality of the credit risks in the financial markets in the So it means quite reasonable to stay at the left-hand side of the scale of the digital information sharing. So to reach the positive effect, the regulators may wait for you need to make a great step in the disclosure. So our additional results shows that these tasks are the hardest for the economies facing lower quality of financial development and the institutional quality, including the property rights protection. So I have to stop here, I guess. Yes, exactly 10:30. Thank you very much for your attention, and I'll be glad to answer your questions after the session.
Thank you very much, Maria. So I suggest now to move to the next presentation. Nargis, are you here?
Yes, I'm here, and sorry for being late because of some technical issues, and I also confused the time slot with Perm.
Yeah,
can
so
you see my?
Yeah, we can see your screen, and you have 15 minutes. So the floor is yours.
Okay. Okay, thank you very much. My name is Nargis Mamedova, and master student of economic research program, HSC Moscow. Today I will present the impact of economic institution and bank competition, stability, effect of bank competition on bank stability, evidence from CIS countries. So our outline will mainly include introduction, motivation, literature review, hypothesis, methodology, empirical results, discussion and conclusion, then references. So starting with introduction and motivation. So recent decades have shown that the bank stability plays a crucial role in terms of ensuring the soundness of financial system. And the role played by the economic institution in terms of contributing to financial stability, namely bank stability, comprises to the affecting the quality of restrictive or regulatory activities undertaken by bank supervision. After the collapse of former Soviet Union, successor states had to transform their financial sectors in a way to meet with the requirements of emerging market economy. And according to Golodnyuk, after gaining independence, those countries had to cope with, deal with how to manage risk, diversify assets, and supply increasingly complicated financial services on their own, because there was no monobank system that used to exist during USSR period. This signifies the inevitable importance of the transparent and well-performing economic institution to ensure that the sustainable development goals set up by these countries are achieved, actually. So the reason why competition is in the center of this analysis is that the previous literature couldn't come up with a consistent sign of its coefficient to decide whether market power improves bank stability or it deteriorates. And previous research conducted to analyze the bank stability in the case of CIS countries, for example, Karminsky, Kostrov, Nabiev, and the others, mainly focus on financial indicators and macroeconomic variables without paying very little attention to the role of economic institutions to see how they affect bank stability. And that's why our research question turned out to be, how do bank competition along with economic freedom indices affect bank stability and default risk in the case of CIS countries? So, continuing with the review of prevailing literature, Sharifova found out that more market power deteriorates overall stability as it invigorates non-performing loans. And additionally, she claimed that larger banks contribute to bank stability considerably more than small banks because they can perform at economy of scale and decline the cost of production. In a separate study conducted by Jimenez and others, the authors found out strong evidence in favor of the competition fragility hypothesis, in the sense that higher bank competition yields higher bank risk. The same result was also revealed by Sarpong. Why? Because they said that in the case of competition, banks mainly concentrate on issuing so many loans to the others, and they don't take control over their credit history. So that's why they don't care about it. The only thing that they care is winning the competition, kind of. Ashraf, in his study, defined that countries with more trade openness have a less bank risk-taking, such that one standard deviation increase in trade openness yields approximately 4% decline in the probability of bank default risk. And finally, he and the others recommended that a non-linear relationship exists between bank competition and bank stability, and it should be taken into consideration by the decision makers, like policy makers, in the banking sector, because there is a threshold level after which the sign of coefficient changes. like positive sign turns out to be negative. So thus the hypothesis that we have turned out to be the following. The first hypothesis says that higher trade openness improve bank stability. Alternative says that no, there is volatility fragility effect coming through trade openness because it increases risks. Second one is that the effect of trade and financial freedom interaction has a non-linear relationship, non-linear effect on bank stability, meaning that there is threshold after which like the signs alternate. And third hypothesis is also similar. It says that the effect of fiscal and financial interaction and on bank stability is non-linear as well. So policymakers should consider their simultaneous effect on bank stability. So we have the banking this sector as a dependent variable in the main model, while we also refer to the ratio of non-performing loans to total gross loans in the robustness test to ensure that our results are consistent. The independent variables are grouped into two parts: economic freedom indices that include monetary, investment, financial, economic, trade freedom, fiscal freedom, and economic decline index. And we have also financial indicators, learner index, HHI, bank system concentration, and Boone indicator. They are the proxies for bank competition, and we also control for liquid asset to deposit ratio. It is not a sign of competition, it's just an independent explanatory variable. Countries include CIS countries, Azerbaijan, Armenia, Belarus, Georgia, Kazakhstan, blah, blah. And time horizon is from 2006 and 2017, and here we have the main model, like regression equation, according to which z-score is set up as the dependent variable that's explained by not only linear and quadratic terms, but also by interaction terms. And the main purpose of adding the nonlinear term is to observe whether there is a threshold effect on bank competition, threshold effect of bank competition and freedom index on bank stability, if there is or no. So coming to empirical outcomes, main findings suggest that more bank power actually deteriorates bank stability in the sample, as the coefficient of the quadratic term for the competition is negative and statistically significant for learner and learner index and banking system concentration ratio. The next important variable to be considered is liquid asset to deposit ratio, whose effect is highly statistically significant, and the sign of coefficient is consistent across 4 models. Higher liquid asset to deposit ratio means that the bank becomes more solvent by reducing risks in its balance sheet during recession or unexpected crisis, which positively affects the bank stability in that given country. A unit increase in financial freedom is found to decline the bank stability, except for the model in which I refer to HHI as a proxy for competition measure. And countries with more financial freedom index are found to have less government control over the financial institution. And because of that, those financial institutions will have incentive to engage in riskier activities, and they will decline their history screening of their borrowers, and they will boost amount of non-performing loans, which will deteriorate again the bank stability at the end of the day. Another intriguing, interesting finding of the study is the sign of the coefficient for economic decline and fiscal freedom index, which suggests that in countries with a higher economic decline index, unit increase in fiscal freedom, if fiscal policy, let's say, becomes more active, it will improve the bank stability. And coming to the results of hypothesis, the estimation result for the hypothesis suggests that we couldn't find any evidence in favor of the trade volatility hypothesis, meaning that increase in trade freedom doesn't actually lead to the bank instabilization, let's say, it doesn't harm bank stability in the country. However, the effect is not statistically significant, even though the coefficient is positive, but it doesn't have any statistical significance. That's why we cannot confidently conclude anything on that. On the other hand, we define that in countries with higher trade freedom, increase in financial freedom yields more stable banking system. It is incrementally significant again. And in countries with high financial freedom, increase in fiscal freedom contributes to bank stability, and this hypothesis is highly statistically significant and consistent results. They are positive across all 4 models. So in conclusion, we found out that countries with more financial freedom experience lower bank stability, and in countries with higher investment freedom, increase in market power deteriorates bank stability, while the opposite is true for the effect of financial freedom. And in countries with higher economic decline, increase in fiscal freedom, or let's say that fiscal policy becomes more active, it will improve bank stability. We also verified the nonlinear relationship between trade and financial, as well as financial fiscal freedom index. And lastly, we defined that there is a threshold level for the effect of bank competition on bank stability, meaning that for the lower values, the effect is positive, but if it increases like after some certain threshold level, it turns out to deteriorate bank stability. So to conclude, we still cannot say that whether the competition entirely positively affects or negatively. There is a threshold level, and it has to be taken into consideration by the policymakers in banking sector. And yeah, thank you.
Thank you very much. I have just posted link on the chat about the paper on economic freedom index for Russian regions. Perhaps it might help you with future research, but I'm not sure. So now we have, thank you for being in time. And for now we have our third presentation of this session, and our presenter is Vladimir Sokolov from HEC Moscow. Vladimir, the floor is yours.
Do you hear me? Do you see my slides?
Yes.
Thank you very much. I would like to thank the organizers for including our paper into the program. So this is a joint work with my former student and current research associate in our laboratory, Amir Khairuddinov. So the topic of our investigation is the behavior of bond funds during the sovereign debt crisis, the Argentinian experience. First of all, I should say that over the last period since the recent global financial crisis, I have a question maybe. No, it's general. Since the recent global financial crisis, the importance of bond funds has greatly increased. So the IMF, for example, reports the 30% increase in issue of high yield bonds held by the bond funds. And this has been documented. Another interesting stream of literature discusses how bond funds are important, how they conduct liquidity transformation, in a very similar fashion to the commercial banks. So there are many similar ways how mutual funds and banks take liquid deposits and transform that into illiquid loans. For banks, and investment into bonds, which is another form of lending to the companies by the mutual funds. So what we do in this paper, we want to study the natural sort of experiment setup when we have a negative shock to the holdings of a group of sovereign funds holding a high yield debt of Republic of Argentina. And in particular, this fits nicely the literature on studying this so-called reaching for yield environment, when given the environment of very low interest rates for the most developed countries, financial institutions such as bond funds, they have to reach for yield and invest into more risky assets, such as, for example, sovereign bonds of countries with a long history of defaults, such as Argentinian Republic. It has important implications for financial stability and debt restructuring. So we contribute to a couple of streams of the literature. One is the bond fund literature. Some of these papers I already mentioned, but there are more, and it's a really growing literature, as you see by the dates of the publications. So, but all these papers, they study the US. So they focus on the US-based mutual bond funds and their portfolio decisions. Some of them already studied the behavior during COVID-19, for example. Another stream of literature to which we relate is about not bond funds, but about the sovereign debt. So basically, these are more macroeconomic, international finance type of papers. But what distinguishes them is that they very carefully look into cases when countries defaulted. They look into the bonds which were issued, and upon which countries defaulted, they look into the process of restructuring, haircuts, you know, all these concessions investors make, negotiations. So it's a kind of interesting stream of literature, and I think we also a little bit contribute to that sort of discussion. But to the best of our knowledge, nobody sort of did the joint work studying the bond funds portfolio, specifically focusing on investment into the sovereign bonds. So in that sense, we believe we'll provide an interesting contribution to the both streams of this literature. So let me briefly give you the background of the Argentinian experience and why we think it's important. So Argentina is known to be a serial defaulter. It defaulted plenty of times in the course of the 20th century. And it has defaulted very big time back in 2001. And it was effectively cut off from the international capital markets. But then there was this nice election for them when the pro-market candidate won, and then Argentina gloriously returned to the international capital markets and borrowed again a lot. But and that happened in 2015. So this pro-market candidate Marci, he settled all the previous court cases with investors who lost money in the previous default. So he paid out all those debts, which were controversial from the domestic Argentinian perspective. So many citizens were not happy about that. But it allowed Argentina to enter again the capital markets and raised something close to $70 billion. However, this was very short sort of optimism, because already 4 years later, in August 2019, unexpectedly, that's important for our identification, because most polls predicted that this Marci will stay in office. He lost to the left-wing candidate. And immediately the financial markets for the Argentinian assets collapsed. So you see loss for the stock market, for the bond market, currency collapse, and so on. So here I graphically illustrate that one graph tracks the behavior of the stock index of Argentinian Republic, another the currency. It was happened overnight. This is since from Friday till Monday on that date. So it's one of the biggest drops in recent financial history. And also what's most interesting for us is to study how the sovereign bonds issued by Republic of Argentina behave. And we took the most liquid ones and also illustrated here and see that the price went down from something 85% per par value to 40%. So it was very steep drop. And for the right reason, because later on, we don't study that, but later on in 2020, Argentina indeed defaulted on its debt. And there was some renegotiations and restructuring, and new debt was issued. So what we do here, we collected the data. We identified all the sovereign international funds that held bonds of the Republic of Argentina, around 1,000 of them, and traced their holdings, Argentinian and other bonds. We also did one more step further. We looked if those funds had experience with the Argentinian debt before in the previous default of 2001. So we specifically went back and checked which subsample of our funds held the so-called Kirchner bonds on those Argentina defaulted 15, 18 years ago. So many of these funds, they're quite old. So some of them had experience with Argentinian debt, some did not. Okay. And then these are our main variables. Dependent variables are growth of holdings of Argentinian bonds over this pre-election and post-election periods. Flow funds, the usual variable for the mutual funds. It's a flow funds of investors into the mutual funds. And then our independent variables is exposure to Argentina. It's a proportion of pre-election holdings of Argentinian bonds to all sovereign bonds in the fund's portfolio. And then this dummy variable, which represents the experience if the fund already held bonds of Argentina back in 2001, when Argentina defaulted last time. Then we also, and the opposite is a newcomer fund. So the fund never had experience with Argentinian bond and only purchased them during this recent episode. We also summarized fund location, and we do it by continent in a sort of a bit crude way. Then we look at the liquidity of a fund, and we look at the weighted maturity of bonds in the fund portfolio, because these variables of interest, they are important, and the literature on mutual funds raises importance of this, and I will show you our expected hypothesis, which is related to these variables. So this is our summary statistics. So we have a cross section about 1,000 funds, and we basically look like this natural experiment type of studies. We measure before the event and after the event, and growth variables and fund flows are outcome variables, and pre-election position such as cash holdings, maturity weighted, they are variables of interest which are predetermined. And we see how outcome variables behave during this negative unexpected shock. So first we also check so-called treatment control balance. So funds with low exposure to Argentina below the median, high exposure to Argentina above the median. So we see they're sort of randomly distributed, and turns out pretty much yes, only return is significantly different statistically, but economically we wouldn't, it's basically 1/4% higher return for funds which had before the elections low exposure to Argentina than funds that had high exposure to Argentina. So this is empirical specification usual in this tradition. So we run this regression where it's a growth over 2 periods on the left-hand side, and then exposure to Argentina interacted with our variables of interest such as cash share in the first one. In the next one, you will see weighted maturity of bonds in the funds portfolio. So here is the hypothesis that high liquidity funds, which initially had higher share of cash in there, so bigger cushion before this negative shock. So during this fire sale event, after this big shock to the Argentinian bonds, they will reduce their position less. So there will be less stress to participate in the fire sale. And those that are low liquidity funds, they will basically decrease their position in Argentinian bonds more. So this is something people usually do. They check if there was a pre-trend, and this is so-called regression coefficients plot. So indeed, it seems like before the elections, for holding growth, there was no significantly effect for cash holdings interacted with exposure to Argentina. And right after election, there was a significant change. For funds flow, another variable of interest, we don't see any statistical significance before or after. So shock did not have any impact on exposure interacted with cash. So fund depositors, basically investors, they did not look into funds exposure and funds liquidity position, but fund managers, they did look. So outside investors did not look into this according to this analysis, but fund managers did look, and if they had high cash, they decreased their position less than compared to those that had low cash and less liquidity cushion. And this basically, these red bars, these are regression outcomes of this table. So we also did same regressions for the pre-election, post-election, we just don't report it here. And then, as I said, consistent with our hypothesis, the exposure coefficient is negative, meaning that the more exposure funds have to Argentina, the stronger they decrease their holdings position in these bonds. They do fire sale. Cash decreases the speed of the fire sale. And this is what was our expected hypothesis, which we confirm. Second test we do consistent with, we looked into some evidence in the sovereign defaults literature. And one interesting finding they have, like these authors, we quote him, Asanuma and co-authors, Fenk and co-authors, they look into sovereign defaults and checked if short-term bonds or long-term bonds had different style of restructuring after the default for different episodes of default in history. And they find that a longer maturity bonds, actually, they did better during restructuring. And so it means for investors, if you happen to be invested in the longer maturity bond which defaulted, it makes sense for you not to sell it outright, because if you have a negative shock and it's a long-term bond, it's more likely that then there will be negotiations. You sit down at the table with the defaulted government in this case, and then you will still negotiate some restructuring which on average will benefit you. So it makes sense for you not to do fire sale, but wait and negotiate and do the restructuring. So we test this hypothesis with basically testing if indeed longer maturity funds held their positions on Argentinian bond more than the decline was less for them than for short maturity funds. So we, in a way, we test the rationality of the fund managers if they know sort of this finding of these researchers and behave in accordance with this finding on the previous cases of defaults. And again, we do this coefficient plots, and we find that for the fund investors, the depositors in the fund, there is no effect whatsoever. So they don't trace the exposure of fund interacted with maturity of bonds in the fund. But fund managers, again, seem to be doing that. So before the election shock, there was no result. But after the election shock and one period after that shock as well, 1 quarter, we see that fund managers with longer positions in bonds, sovereign bonds, they actually decrease their holdings less following the shock. And this again confirmed by these regression results, which correspond to that red bar on the picture, which was just previously reported. So we see that in a way, longer term maturity portfolio of a fund offsets the fire sale decision of a fund manager. But for funds flow, the investors in the fund know any pattern. There is no pattern. So they don't behave in accordance with the fund's maturity holding and exposure to Argentinian bond. Finally, our final result, so we have, because we sort of want to study this question in multiple dimensions, which could be of interest to researchers in this field. So we look into that variable I described before, if the fund was a newcomer or the experienced, if they had Argentinian bonds before or, in the previous default or not. So then again, when we do the balancing on treatment and controls, just for the whole sample, for this situation, the funds which are old and then are new, on observable characteristics, they are quite different. So pretty much all means are very different. So for example, funds which are experienced, they considerably, for example, older, which is probably expected. They're bigger, the return is higher, and so on. So in order to sort of meaningfully claim causality, one need to sort of balance this situation. And what researchers do in this case, we do this so-called propensity score matching, when we do the analysis not on the whole sample, but we match the on observable characteristics, the subsample of experienced funds to the newcomer funds. So we find 2 subsamples which basically have similar observable characteristics. So there is this technique. So that's what we do. And then we will study it only based on that propensity score match subsample. So these are some diagnostics. And here we do this regression on the match sample of newcomer and experienced funds. And we also interact that newcomer dummy with the geographical location of a fund manager. And the idea is that there is this literature on asymmetric information across funds and different institutions based on how remote they are to the center of the event. like banks being distant from the firms to whom they lend, and so on. So in this case, we know that there will be renegotiation, and the sovereign funds, they issued under New York law in New York, and all previous settlements were done in New York court. So the hypothesis is that fund managers located in the Northern America, they have less symmetry of information, let's say, than fund managers located in Asia and Europe. So interaction of experience and location gives us sort of the most strong kind of proxy for the asymmetry of information across funds regarding the outcomes of the future renegotiations, and we can test if that impacts the outcome variables, the growth in the positions, participation in the fire sale. So
I'm sorry to interrupt. Can you finish in a couple of minutes?
Yeah, sure. So let me then quickly go to the regression results. So these are all interaction dummies. The reference category is experienced North American funds. So the ones that have in our hypothesis the least asymmetry of information. They are located to the New York court close by, and they already held Argentinian bonds before, and they already ran multiple negotiations in their history with the Argentinian government. So they will be the least asymmetrically disadvantaged in that case. In terms of information. Then we have newcomer funds. These are North American newcomer funds and newcomer European funds, experienced European funds. And it seems like relative to this reference group, again, on the propensity score matching, the experienced American funds, they had lowest participation in this fire sale. But interestingly, newcomer European funds, I guess these are more sort of opportunistic, gambling for resurrection type of funds, they entered. So this type of funds did the fire sale. The experienced North American funds held, but those newcomer European funds, they bought from those that did the fire sale. That's kind of what we see. And here is a conclusion. So we have a rare event of sovereign default. We trace the behavior of the fund managers. We find that funds which went out with more liquid position in the first place, more longer term maturity bonds, they did less fire sale relative to other type of funds. And then experienced North American funds, they also participated in the least fashion in the fire sale of Argentinian bonds. But then there was some newcomer European funds that actually maybe gambled for resurrection and took this distressed debt and had some sort of strategy to, get a high return. So thank you.
Thank you all. Thank you, Vladimir. And now we have a couple of minutes for questions and for a short break after that. Maria asked to drop the questions to her email. It is in the chat. So I suggest now to give comments to Nargis and to Vladimir. So Nargis, I already posted the link to the paper in the chat. I hope that it might be useful if you will continue on analyzing regional level effects and how economic freedom and different components of this index affect banks. And any questions to Vladimir? Because I was I read his paper, and during the presentation I was making notes, but during the presentation he already answered all the comments which I intended to ask. So please help me with the comments to Vladimir.
Well, that was a very interesting paper, as usual. I was wondering most of the time, especially when you mentioned elections, and I was doing some work on elections recently. I was wondering if you can distinguish in your data the expectations effect, what fund managers expect about the economy for the future, or the uncertainty effect, when they sort of, because when there is a sovereign default announced, you really don't know how the country is going to develop in the future. So there may be significant behavioral pessimistic effect, and that might expect that, for example, European funds, which are not subject to that pessimism and which are better diversified, they can run into the market to explore this undervaluation, for example. If you understand what I mean. I'm sorry for being a bit messy.
No, I understand. Yeah, that's the problem with this type of studies, because yeah, we have a shock, but there could be many mechanisms how this shock impacts the funds. So, for example, in this recent piece, I guess to which you relate, we claim that this is due to asymmetry of information, right? But there could be other explanations. And for example, you come up with one. It could be that, let's say, sentiment, right, and different distribution of knowledge regarding the not near negotiation outcomes, like I said, but maybe macroeconomic evolvement of Argentinian budget, so on. Yes, that's true. I guess in sort of robustness tests, one should have as many of those alternative explanations being tested and rejected or chosen as the right ones. Yes, thank you.
Thank you.
Yeah.
So good afternoon, everybody. Well, it's good afternoon in Perm. It may be still morning in some other countries. And welcome to this session on inequality and macroeconomics. So this is a composite session containing several topics, which may be probably called like a sustainability in the very general sense of it. And our first presenter is Shishir Roy on gender gap and poverty, which is a very interesting title. And I saw the paper and I'm looking forward to the presentation. Shishir, are you here?
Yes, sir, I'm here. Thank you.
Yes. So you should be able to share your screen.
Yes, I'm sharing. Thank you giving me opportunity to present my paper in this renowned conference. Today, I'm presenting my paper, The Gender Gap in Poverty Biased by Caste in India, an empirical analysis. Gender inequality is a major obstacle to the overall progress of the human race. Women's empowerment, defined as a full participation of women in all aspects of life, beginning with political decision-making, can be a powerful weapon for eradicating gender inequality. Although gender inequality is present in almost countries of the world, it is particularly evident in countries of Asia, Africa, and Latin America, and India is one of them. Indian society basically has a long history of being divided into different castes. This system dates back a few thousand years and has come a long way. A long way since then. Based on this idea, the lower castes in economic arena, particularly Dalits, those are called the scheduled caste according to Indian constitution, and Adivashis, the scheduled tribe, have been deriving to the margin. When we look at the economic content of the caste system, it is clear that certain occupations under the caste system are specific to a certain caste. So the concept of immobility has been originated from historically in India on any ground of socio-economic perspective. So we see in immobility in education, political power, and business since and before independence. Education was a peer's only right. Political power was a warrior's only right. Business was a merchant's only right. So the entanglement of social state and religious discipline in India has forever imposed on women and lower caste imposed on women the responsibility of caring children, relatives, and all the responsibilities of the household In this social discipline, every moment of life from birth to death is under the control of men. In India, several state laws have been enacted since the 1950s, when the Indian Constitution is implemented in India to establish family and social equality between men and women in line with the Constitution's commitment to impartial equality, socio-economic and political justice. Although still about 70 to 75% of women in India are employed in the unorganized sector, mainly agriculture and agro-based manufacturing. And many of them women workers do not get the opportunity to work more than 6 months in a year. More or less and semi-skilled women are typically employed in labor-intensive jobs. Sorry. So the main motivation we get from to do this study from the 2011 Socio-Economic Caste Census Survey. This is the last census of India. This survey reveals that the socio-economic status of 179.7 million households, and revealing that 70.7 million households are not poor, 1.6 households are suffering from severe poverty, and 87 million households are victims of deprivation. And the same survey also reveals that that 71.99 and 74.48% of scheduled caste and scheduled tribe families suffering from deprivation. So the article arose from the teacher to learn more about the size of national gender gap in poverty of workers, as well as the caste-based gender gaps in poverty among India's working population. The primary objective of our research is to determine the gender gap in poverty incidence, depth, and severity among second generation workers at national level as well as different caste wise. Another important objective is to find out the composition and coefficient effect of exogenous characteristics on poverty gap between male and female workers at national level or by the caste. So data we have to use here, the data is India Human Development Survey data, a nationally representative multi-topic panel survey of 42,152 households in 384 districts and 1,420 villages and 1,042 urban neighborhoods across India. Was conducted by India Human Development Survey, and the research from the University of Maryland and the National Council of Applied Economic Research, New Delhi, jointly organized ISDS. So in this study, we use basically the mobility composition, service composition, educational composition, age composition, household composition, employment composition, and residential composition. And to do this paper, we had to use FIFO14 and LUMEX model, which was the extension of the Osaka Blinder Reef regression model, which was developed in 2018. Simply I am explaining the model that in this model we consider a joint distribution function which establishes the relationship between the dependent variable, that is the monthly wages, and the independent exogenous characteristics and a group variable, that is the sex variable. So the joint distribution function is this is the joint distribution function, and we have to consider here the cumulative distribution function, which is represented by the equation 2. And our target is to find out that delta FGT is the poverty index for Foster, Gray, and Thorbeck index, which is used as a distributional statistic here. And we want to find out delta FGT and which factors, these exogenous factors, reduce or increase the poverty gap. Now, the delta FGT will arise because because of difference in the distribution of exogenous characters. That is this is due to difference in the distribution of exogenous characters, or the gap in poverty will arise because of difference in the relationship between the wage and the exogenous characters. So next to do this, we should establish a counterfactual term counterfactual term or scenario to understand how significant difference in characteristics, that is the composition effect, or we can say it policy effect, or difference in coefficients, or this is called, alternatively we can say that is the wage structure effect or coefficient effect. And once this is the process of calculate the counterfactual statistic identification, but there is a problem that faced by the FFL, FIRPO 14 and LUMEX, and then they have to provide it to calculate the reweighting factors. That is they say that reweighting approximation to identify the counterfactual distribution based on the observed data. The challenge of defining the counterfactual scenario is that the distribution of outcomes and features that the counterfactual distribution is not explicitly observed. That's why they use an approximation for counterfactual distribution that can be obtained by multiplying the observed distribution of characteristics with a factor psi e. Hence, it is identical with which is represented by the equation 11. Now, once the reweighting factors is obtained, then we will come to our final equation, which we will estimate in this paper, and the equation is the 13. The equation 13 explains that the first two parts of the equation reflect the Osaka blinded aggregate wage structure or coefficient effect, that is the Wallace effect, whereas the second two part corresponds to the aggregate composition effect, effect on the poverty gap. These two components, first two components are also divided into two terms. First one is the pure composition wage structure effect and the composition effect, plus and that can be used to evaluate and the two term is used here to do fitness of the model. That is, one is a reweighting error. This is the reweighting error, and this is the specification error to understand or to make out the model significance. So now,
Shishir, just want to remind you, you have about 3 to 4 minutes remaining.
Okay. So, we have to use here this composition. Now we will go to the model specification. The model specification is when I'm very shortly saying that model specification is that when reweighting error and specification error is significant, then we can check the results is significant, or we can analyze the effects of the exogenous characteristics on the poverty gap. So this is the important findings in India. In this first table, we find that this is the national level gender gap in poverty of the working class in India. We find that male working is, this is the FGT index of the head count ratio is 0.1213. This means 12.3% of male workers in India is earning is below poverty level, and female is 38.7%. So easily we can counter that. Here is 26.3%. This is the 26.3% is the gap between the male and female workers. So, and similarly is the poverty depth. We can get is 14.2% poverty gap in poverty depth and poverty severity also. So, and here we can see that specification error and reweighting error both are 1% level of significance. So we can consider here composition, pure composition effect and pure coefficient effect on the poverty gap. So the mobility composition, where we have to use the educational mobility and income mobility, because we see that historically in India, education and business or employment is there is a immobility. So we have to use here the mobility composition. The mobility composition has a negative effect on the poverty gap. This is the poverty gap, and the mobility effect is negative. So if there is educational mobility, then there will be the income mobility, and this will help to reduce, this composition will help to reduce the poverty gap in India. So similarly, it is true for the poverty depth and poverty severity. And we have also, and there is no counterfactual effect from the pure coefficient or Wales effect. And so similarly, the service composition effect, but it is helpful to reduce the poverty gap, but there is a counterfactual effect from the coefficient change or pure coefficient change. So there is a heterogeneity in the service composition, and this will help to increase the poverty gap between male and female. So similarly, household composition is totally helping to reduce the poverty gap. Similarly, employment composition also helping to reduce due to heterogeneity in employment composition and increasing the poverty gap. Residential composition in the rural area in India, the opportunity set, the availability of opportunity set of women or girl child is very limited. That's why we have to see that residential composition helping due to a counterfactual fear from the coefficient, pure coefficient effect, and it helping to increase the poverty gap. So similarly, this is the national level, and this is the higher caste level. We also find that mobility is a very important factor to decrease poverty gap between the higher caste male and higher caste female. So other results we are already I already discussed in the national level. So then we come to the mobility in the other backward classes, whose population is 52% in India. In this case, that OBC this is the OBC, that male OBC and female OBC, there is also a gap in poverty, and we get that mobility, educational mobility and income mobility composition helping to reduce the poverty gap in India. And it is also, yes, sir, I am concluding this.
Thank you.
Okay, sir, 1 minute, sir. 1 minute, please. This is the conclusion that sir, 1 minute. The gender gap in poverty of workers is ascending order among the caste. Gender gap in poverty of upper caste is less than the gender gap in poverty of OBC and the gender gap in poverty of SC/ST. And these findings suggest that the gender gap is poverty is skewed by the caste. And the important finding of this research is that the composition effect of intergenerational educational mobility and income mobility is an important determinant to reduce the poverty gap between male and female workers and residential and employment composition. So the government should provide more opportunity to the female worker or female child in rural area. So education brings about the welfare of entire human race.
I think we have to stop. We have to stop here.
Thank you, sir.
Because we have 5 other speakers. Thank you very much.
Sir. Thank you, sir. Thank you.
Yeah, if you stop sharing your screen.
Yes.
Yeah,
thank you.
Then the next speaker is Gaurav Damija, who. Gaurav, you can now start sharing your screen. Indeed.
Yes, I've shared the screen. Can you see this?
Yes, we can see the slides. The floor is yours.
Okay. Thank you. First of all, thanks for giving me this chance to present this work on this platform. So this work is a joint work with Dr. Punarjit Roy Chaudhary, who is associated with Shiv Nadar University in India. So without taking extra time, let me jump onto the slide. So domestic violence is actually a global social problem of epidemic proportion. It affects 1 in 3 women in their lifetime and is the most common form of violence in women's lives, both developing as well as developed countries. So women who suffer domestic violence experience serious health consequences in terms of injury, depression, post-traumatic stress disorder, and many other consequences. The cost of domestic violence to an economy in terms of victim suffering, medical bills, lost productivity, judicial expenditure, and the lost productivity from the incarcerated offender is also huge. According to an estimate by Fair and Hofer, they find that intimate partner violence costs the world around 5.2% of the global GDP, which is actually 25 times the total cost from various conflicts such as wars or terrorism, refugee-related costs, and other related economic damage. So given the massive adverse socioeconomic consequences of domestic violence, it is crucial for policymakers to design policies and interventions that would be effective in reducing the extent of domestic violence. However, in order to find what policies can actually work, we need to understand what are the possible causes that actually lead to domestic violence. So this is where we step in and try to find that one of our potential cause of intimate partner violence, which is not explored till now, that is violation of hypergamy. How does this play a role in the determination of domestic violence using Indian data? So what do we mean by hypergamy? So hypergamy occurs when in a marital relationship, the husband's economic status is systematically higher than that of his wife. And it is actually widespread in almost all the patriarchal societies that we have. And the violation of hypergamy occurs when the wife's economic status is equal to or it is actually higher than that of her husband. So this violation of hypergamy can lead to domestic violence for two reasons at least. Now, first is it undermines the traditional patriarchal beliefs and norms that that men should earn more than his wife, or he is the primary breadwinner in the household. So this could lead to some sort of stress, tension, and often lead to severe domestic violence in the form of male backlash if woman is earning or woman's economic status is higher than her husband. Then secondly, violation of hypergamy can lead to domestic violence for instrumental reasons. Now, this happens when domestic violence is actually used by the men to extract the financial resources from their wife or to sabotage their labor market prospects. In contrast to these lines of arguments, theories of intra-household bargaining suggest that violation of hypergamy can actually reduce domestic violence because they assume that women actually receive some sort of transfers from their husband as a compensation for violence. So as women's economic status actually increases, the price of violence is likely to increase, in which case either the level of violence will go down, or if it is not, then the relationship will break down. So theoretically speaking, whether violation of hypergamy increases or decreases domestic violence is actually a priori ambiguous. So what do? We try to understand using, we try to estimate the effect of violation of hypergamy on women's exposure to domestic violence by using non-parametric identification approach because of the two simple reasons, because it cannot be calculated by using simple OLS estimation. Now, why? Because there are important unobserved factors that could be correlated with the type of the marriage, that is whether it is hypergamous marriage or non-hypergamous marriage, and also directly influence women's exposure to domestic violence. And these factors are, for example, patriarchy, women's patriarchy in the natal household or in her husband's household, or unobserved ability of women. So in addition to these unobserved variables, reverse causality can also play a significant role. So domestic violence can actually decide or can lead to the determination of hypergamy violation. So because of these reasons, actually a clear or clean estimation of the treatment effect is relatively difficult. So what we do, we actually use non-parameter partial identification approach. So if you look at this equation, in this equation, Y1 depicts the potential intimate partner violence faced by a woman if she was in a non-hypergamous marriage, and Y0 depicts the potential IPV faced by a woman if she was in a hypergamous marital relationship. And the average treatment effect would be the mean difference in the mean if all these women were in non-hypergamous marriages versus the mean outcome if all these women were in hypergamous marriage. Now, unfortunately, we cannot evaluate that because at one point of time, one of the potential factor, one of the potential outcome would be visible and the other one would not be visible. So what do we do? So in the presence of this identification problem, what we do is actually we derive bounds on the average treatment effect using some minimal and transparent assumptions related to the nature of selection process. So as a first step, what we do not impose any assumption on the selection into the treatment and use the law of total probability and the fact that conditional probability lies in the range of 0 to 1 to bound the individual components of average treatment effect. So if you look at these two equations, and if you find the difference between the upper bound of the first equation and lower bound of the second equation, then we can actually find the sharp upper bound on average treatment effect. Similarly, if we take the difference between the upper bound of the second equation and lower bound of the first equation, then we can get the sharp lower bound on average treatment effect. Now, the problem is with these bounds, without any assumption, the width of these bounds would be actually equals to 1. And it will always include 0. So we will not be able to decide the actual direction of the average treatment effect. So to make it more precise or make it more narrower, we impose our first assumption, that is MTS, monotone treatment selection assumption. So that assumes that expected potential outcomes move in a particular direction conditional on treatment assignment. So in our context, what we mean by this is that women in hypergamous marriages are more likely to face intimate partner violence as compared to women who are in non-hypergamous marriages conditional on treatment assignment. And this assumption actually helps in tightening the bounds of the average treatment effect. Now you can ask, what is the basis or how do you justify this kind of assumption? So we believe this kind of assumption is plausible in our setting where patriarchy is very high, while level of patriarchy is very high, and hypergamy non-violators are likely to be from disadvantaged backgrounds as compared to those who violate hypergamy. And across, this is true across economic, social, and demographic characteristics. For example, compared to hypergamy violators, the prevalence of patriarchal attitudes in hypergamy non-violators' natal home as well as in husband's home is likely to be higher. And this is because hypergamy is a fundamental principle of patriarchy. And in case of hypergamy non-violators, adherence to this principle is actually clearly observed. So given that hypergamy non-violators' natal home and husband homes are likely to be more patriarchal than that of their counterparts, and because patriarchy actually naturalizes domestic violence, it is likely that hypergamy non-violators and their husbands are more likely to consider domestic violence as a norm than the hypergamy violators and their husbands. This in turn is likely to make hypergamy non-violators more susceptible to domestic violence compared to hypergamy violators. And in fact, that is true that given that the natal homes of hypergamy non-violators are likely to be more patriarchal than that of hypergamy violators, even if the former does not consider domestic violence as a norm, they might be still more tolerant of domestic violence than the hypergamy violators, since the option to leave the marital relationship is includes very high social cost for the hypergamy non-violators, because it is considered some sort of taboo if you are living alone or not living with your partner. Another reason why we think this assumption is justified is because the prevalence of higher levels of patriarchy in the hypergamy non-violators' natal home and their husband's home compared to that of hypergamy violators' natal home and their husband's home could also make the relatively low status women more disposed to domestic violence than their counterparts due to extortionary reasons. We know that the culture of dowry is very prevalent in India, and the recent work by Anukriti and her co-authors have shown that it has actually grown in last 6 decades. So the husband's family often continue to make demands for monetary payments even after the marriage, and it is very likely that such dowry demands are higher in high patriarchal environments compared to the low patriarchal environments, since dowry demands are ultimately an indicator of patriarchal attitudes. And there is a large literature which actually finds that dowry demands are positively correlated to domestic violence, and this is likely to suggest that hypergamy non-violators have a higher likelihood of facing domestic violence than their counterparts. Moreover, it is likely that hypergamy non-violators have lower levels of education in absolute terms than the hypergamy violators, and this is likely to cause the former to have lower options of outside marriage and therefore a lower likelihood of living an abusive relationship than the latter. So given the
4 minutes, please.
Yes, got it. Given the exposure to domestic violence is negatively related to women's options outside marriage and the likelihood of living in an abusive relationship, and this is likely to make hypergamy non-violators more vulnerable to domestic violence than their counterparts. So this is how we justify our first assumption of monotone treatment selection. Now, in addition to this, we also impose another assumption, that is monotone instrument variable. Now, MIV, just to clarify, it is not a typical instrument that we have in instrumental variable estimation, which is required to satisfy exclusion restriction. Now, in our case, MIV is required to satisfy only one thing, one condition, that the potential outcomes must vary monotonically with the variable used as an MIV. And in our context, we use MIV such that lower values of MIV are associated with higher likelihood of domestic violence. So to do that, what we do, we use two MIVs in separate analysis. One is state level literacy rate and one is gross state domestic product per capita measured at the constant prices in the woman's state of residence. And our belief is that higher levels of literacy or higher levels of gross state domestic product per capita, both are likely to reflect higher local level development, in which case you would see some sort of better governance system or criminal justice system, and which is likely to reduce the patriarchal culture, and women are likely to less likely to face any kind of domestic violence. So our data actually comes from the National Family Health Survey. So we are using the 2015-16 survey, and what we have is we are looking at 5 binary outcomes of domestic violence: whether woman has faced severe physical violence, whether she has faced less severe physical violence, sexual violence, emotional violence, and one indicator for overall violence. So our outcome variable takes a value 1 if she has faced the violence, otherwise it takes a value 0. And we measure hypergamy violation by the education attainment. If the woman's education attainment is actually higher, it is actually equals to her husband's education, then we consider that she has actually violated the domestic violence. So these are our main results. So I am showing you results for 4 different outcomes here: less severe physical violence, sexual violence, and emotional violence. In one graph, you can see that I have presented 4 bars. Now, first one is without any assumption. Second is if we invoke the first assumption, that is monotone treatment selection, and the third and fourth are based on 2 separate MIVs that we have in analysis. So just to interpret one of the results for that, what we find is that violation of hypergamy actually increases the prevalence of domestic violence by at least 16.1 percentage point as compared to their counterparts. And this result holds true not only for less severe physical violence, but for physical violence, sexual violence, emotional violence, and for any type of violence that we have. Then we have also looked at the mechanism.
Well, can you round up in 1 minute, please?
Yes, I'm done. So we have also looked at the mechanism, and we find that it's actual violation of gender norms and usage of IPV, through which actually violation of hypergamy increases in domestic violence. We have also done some robustness check as well as heterogeneity checks. So just to conclude, our conventional wisdom generally suggests that if we try to promote gender equality, then it is actually likely to reduce intimate partner violence. But what we find is actually contradiction to that. So we are not saying that all sort of gender equality schemes should be prohibited. What we are saying is that along with these kinds of gender promoting or gender equality policies, we need to bring up some sort of change in the gender norms, or we need to bring up or enforce the legislation so that women could get legal protection from the intimate partner violence. So that's where I will stop. Thank you.
Thank you very much. Very interesting paper. The paper actually contains many more results, so I would highly recommend everyone who is interested in the topic. And the whole idea of going away from hypergamy and getting even more domestic violence, that sounds a little bit unusual and goes against the standard intuition. So therefore, if anyone interested in inequality, women's rights, I highly recommend to read the paper. This is available on the webpage of the conference. We now proceed to the further issues of sustainability, environmental behavior, and Dmitry Kashin has the floor. Dmitry, you can share your screen.
Thank you very much. Good afternoon, dear colleagues. I would like to present our paper, which is called Declared Environmental Priorities of this Government as Implicit Incentives for Organizations to Act Green. This is our research with my scientific supervisor, Dmitry Vinogradov, and co-supervisor Elena Shadrina. It is now under review in Ecological Economics, Q1 Scopus Journal. And we are welcoming all the comments after 2 more speeches. So let me start from the motivation of our research. It's a common fact that state priorities have every government in every country. They are defined and they may be in different spheres, in the sphere of economics, for example, in the sphere of defense, and they may have different prioritization. As well as every government now has a modern topic as the priority of environmental safety. So this priority of environmental safety, we focus on this priority in our research, may be formed by different activities from the government as well as from other economic agents. For example, the government may shape the individual behavior of economic agents within the environmental safety priority, may impose the interactions between in the B2B sector and other things, as well as public procurement mechanisms. In European countries, public procurement mechanisms impeding the environmental safety priority are used very well. There are some objectives of environmental safety set in the directives of European Union and in the national legislation as well. But what about our country, about Russia? So in Russia, the priority of environmental safety is stated in presidential decree and in the strategy of environmental safety up to 2025. But however, the priority of environmental safety is not enshrined and is not regulated by the laws that regulate public procurement in our country. In Russia, we have two laws. It's 44 federal law and 223 federal law. 44 federal law is more rigid law, while 223 federal law is less rigid or more flexible law for public bodies. And the motivation is that for public procurers, this priority is implicit. So the effects, how economic agents, that is public procurers, how they operate under this governmental priority are unknown. So the research question is that the government declares certain norms as a prioritized objective, but they are not enshrined in the existing legislation in the public procurement. So how do public procurers apply these environmental criteria in the procurement procedures? If they apply them more frequently or less frequently? And the question is, what types of public organizations in Russia are more willing to use these criteria in their procurement procedures? And of course, the determinants of the choice of public procurers we also examine in this paper. So the theoretical background is very deep in this research. The literature distinguishes and disentangles between two types of priorities. These are explicit ones and implicit ones. We call them discouraging channel of governmental pressure and encouraging channel. And there are different works regarding explicit and implicit regulation. And as I mentioned, that environmental priority is an implicit one in the Russian Federation. So the research question is also stated in the top journals. On the slide, we may see the top papers in Econometrica, in American Economic Review, but still this question, how economic agents behave under different regulatory pressure, is not still solved. In our paper, we have a theoretical model, and the main aim of theoretical model is that when the government poses an explicit incentive, it's called alpha there on the slide, every economic agents need to behave as the government said. So they need to provide business with environmental procedures and conduct these environmental procedures as well. But when we speak about implicit regulation, so in Russia we have no explicit regulation on environmental safety in public procurement. We evaluated the aim function of a contracting authority and minimized it, and what we've got, we solved this model, and we've got that an important role information plays in the decision making of the contracting authority. So when the regulation is implicit, when the regulation is explicit, it's rather clear that every contracting authority needs to purchase as the regulation says. But when the priority is implicit, the information factor prevails. So we decided to prove this on empirical basics, and we constructed several hypotheses. Our main hypothesis is that organizations operating under 44 federal law and 223 federal law will apply this environmental criteria differently. We assume that more flexible law is, more environmental criteria the public bodies will implement in their procurement procedures. The next key hypothesis is that federal and regional authorities will more often implement environmental criteria than municipal ones, and this is because of an informational factor, because if the informational factor, or how we call it, an encouraging channel doesn't work, federal, regional and municipal authorities will need to implement equally these environmental criteria. But we hypothesize that federal and regional, they more frequently conduct environmental procedures. And we also have some control hypotheses as well about the size of organization, presence of procurement department, knowledge about environmental criteria, and etc. So what about our data? We have a questionnaire we questioned 275 public organizations from 22 regions in 2017-2018. And after cleaning from the outliers, we've got the profiles of 223 public organizations in Russia operating under 2 laws. It's also a peculiarity of Russian procurement system that only in Russia, not in any country in the world, we have 2 laws. One is more rigid, it's 44 federal law, and one is less rigid, it's 223 federal law. What about the methodology? We tried to evaluate our models with the help of econometrics, and so we got several series of regressions. Our dependent variables in these are all probit regressions, and the dependent variable is built like in 4 types. So one type is if organization ever applied environmental criteria in procurement procedures. Economic energy is like a proxy variable. We try to disentangle between the most used environmental criteria in Russia. It's an energy efficiency criteria. In construction, it is used almost everywhere, and we call it eco-neo energy. So every other criteria except energy efficiency. It's the second dependent variable. The third is the repetition of eco procedures in the per year for contracting authority. And the last is we try to estimate life cycle costing in our regression probit models.
Tima, you have 5 minutes.
Thank you. We then try to disentangle between this caution factor and loyalty factor. As I said, that is the rigid legislation influence contracting authorities, or it's also the information factor. We constructed a series of more probit models, and what we've got. So who apply eco criteria in Russia? We see that contracting authorities under 223 federal law, more flexible federal law, apply eco criteria more frequently, and we got a robustness check on this graph. So we see that in every group under more flexible federal law, where the public choice is more on the contracting authority, not on the government, this type of public bodies, they implement eco criteria more frequently. We also prove it on our regressions, and the main thing on this slide is that the variable law, which takes 2 values, 1 and 0, 0 is 223 federal law, 1 is 44 federal law. The sign is negative. So again, we see that under 223, more flexible federal law, contracting authorities implement eco criteria more frequently. We also got some difference between level of power in 44 federal law. We again show that standards and information matters for public bodies. Under 223 federal law, we got that more commercialized structures implement more frequently eco-criteria than partly depended by the government. So it's the second main result in our paper. And what about hypothesis? So we've got that there is a heterogeneity between two laws, between different types of organizations, so more rigid regulation and more flexible regulation. The information factor works, and federal and regional authorities are they more frequently implement environmental criteria. And some of our control hypotheses also were examined, and we got that big organizations in Russia are more inclined to implement environmental priorities than small ones. The presence of public procurement department doesn't work, and it was not verified. So and other our control hypothesis about information and knowledge about eco-criteria, we may see that all of them were examined, and they the knowledge influence. The main result is this. To sum up, we have a robustness check in our results, and we in the questionnaire had a question considering barriers for implementing environmental criteria in Russia. And we've got that the political barrier that we call a caution effect there is more influenced by 44 federal law contracting authorities, and the information is more needed for 223 federal law. This is the additional approach to disentangle between loyalty and caution factor in our research. And so all in all, we prove that Russian public bodies use environmental criteria in their procurement procedures, and that information matters. That's all. Thank you for your attention. We'll be ready to answer every question.
Thank you very much for being over punctual. We're back on time, and I would deter all questions to the break, well, the time after break, or please write them in the chat so that Dmitry can read them. And our next speaker is Wahid Ali. Is Wahid here?
Yes.
Yes, so the floor is yours, and the next talk is
so
about
much.
globalization, renewable energy consumption, and economic growth.
Yeah, thank you so much. Hello, can you see my screen?
Yes, it says started screen sharing, but we cannot yet. Now we can see your screen.
Okay. Good afternoon, everyone. Today, the topic of my paper is revisiting the nexus between globalization, renewable energy consumption, economic growth, and environmental quality. We have taken this study on the case of the South Asian countries. So starting from the introduction, recently we know a lot of the research is coming from different countries and regions on the environmental quality. And we have also noticed that there are different determinants and factors have been identified on the responsible factors of environmental degradation. And some of them are the industrialization, population growth, urbanization, deforestation, and the increased transportations. So in the case of the globalization, studies are very rare. So we have taken this into account. The globalization, on one side, we can see that has fostered the industrialization and has caused increased industrial waste and a polluted environment in the shape of the air, water, are the different environmental pollutions. So in the studies, in the literature, there are two main conclusions of the globalization and the ecological or the environmental relationship. One is the globalization have the negative impact on the environment, and other is the globalization don't have any effect, but it might have a positive effect. So it varies in the different regions and countries and the studies. And also in the case of the renewable in the energy consumption, we have seen that if the energy consumption is non-renewable, that might have the negative impact on the environment, because the non-renewable energy consumption releases the different harmful waste to the environment and the air, land, or the different water resources. So when we are talking about the renewable energy consumption, that is the alternative energies, like the energy obtained from the solar, wind, or the biomass, these type of energies, they don't have the negative impact on environment. So similarly, we can see the different studies have used this type of variables earlier, like the globalization, renewable energy consumption, and economic growth in different regions and countries. But in case of the South Asia, there is no study have highlighted this type of the topic, because and we need to investigate this topic on these countries, because these countries are the developing countries, and these countries are at the initial stage of the development, and the environment is highly polluting day by day, such as we can take the case of the Pakistan or the India. The environmental pollution is increasing in these countries is at very fast rate. So in the literature, we can see the globalization and the environment have the mixed results. Like in certain studies, they have obtained the results that the globalization increases energy demand in the countries, and which affect the natural environment. That was studied by the Charfirini in 2017. In contrast, the other study of the Shabazz in 2017 and Usman in 2020, they argued that the environmental globalization in the countries don't have any negative impact, although they could have positive impact, because if the environmental regulations have the high quality environmental regulation in the countries, that might increase the environmental quality in the countries, because the globalization bounds the countries to follow the international regulations on environment. So similarly, in the literature on the renewable energy consumption have also identified that the renewable energy consumption improves the environmental quality in these countries. So and Usman in 2020 also found that the renewable energy consumption improves the environmental consumption. So most of the studies, almost all studies have identified that the renewable energy consumption increases environmental quality. However, some of the studies have found the insignificant effect on the environment. So in case of the economic growth and the environment, that is also very discussed topic, and studies have found that there is the environment. They have studied the environmental coordinate curve, EKC, found in the different countries and regions, and they found that the initial level of economic growth, the natural environment is polite, but after gaining the certain level of the development, the country's the environmental level improves because of the development, and because maybe the investment in the environment and increased awareness in the nation, that might increase. So research methodology in this study, we have used the main variables in this study. We used the dependent variable is the CO2 emissions that describes the so in the model we use CO2 emissions as a dependent variable, and the independent variables are the renewable energy consumption and globalization and the economic growth. We have taken the data of 5 countries of the South Asian developing countries like India, Pakistan, Sri Lanka, and Nepal. And data was taken from the 1990 to the 2014, because the data was available on the World Bank database for the CO2 emissions was up to the 2014. So we taken all the data until the updated data until the 2014. So the independent variables data like the real GDP, globalization, and all also taken from the World Bank. For the data of the globalization, we took the proxy of GOF index, that is a globalization index, and it measures the globalization in terms of the political globalization, economic globalization, and the financial globalization. This is the unit of the globalization is globally accepted. And for the economic growth, we used real GDP growth, and moreover with the data of renewable energy is also taken from the World Bank. So in empirical methodology, we took the first cross-sectional dependence test and the unit root test and co-integration test before analyzing the long-term relationship among the selected variables. So for the cross-sectional dependency, we know that these countries are very much interrelated in terms of the trade and the culture and the mobility and the economic way. We can see that these countries are interrelated. So we have taken the cross-sectional dependence test. So if we see the results of the cross-sectional dependence test, we can see the results are the positive. That means the hypothesis is accepted. That means the cross-sectional dependency is present in these countries. So because of the presence of CD, we use second generation unit root test to check the stationarity condition of the variables in our data. So for the second generation unit root panel unit root test, we have used the CRDF and the SIPs. So if we see the results of all variables in these two tests, we can see we have the stationarity condition of all variables on the first difference. In CRDF and SIPs in both, we can see that we have the on the first difference. So in this condition, we are able to use the long-term FMOLS or the DOLS co-integration test. So for the panel co-integration test, we use a different co-integration test like such as the Westerlund, Pedroni, and the cow unit co-integration test. So results from the co-integration of the Westerlund co-integration test, they are also significant. Mostly they are significant. That means there is a co-integration among the variables, and also in case of the Pedroni test, the results are also significant. So the co-integration is established, and thirdly, the co-integration test of the cow in 1999, that is also significant, showing the significant results, and that means we have found the co-integration among our variables. So after found the co-integration among variables, we have formally used for the long-term relationship between our dependent and independent variables. We have used FMOLS, fully modified OLS, and DOLS, dynamic OLS. So in this case, we can see in this table the results like the globalization had a positive and the significant impact on the CO2 emissions. Like for example, when the globalization increases in these countries, the CO2 emission increases. That means it decreases the environmental quality. And if we see in the case of renewable energy consumption, which is showing the negative sign, and the significant sign which shows the renewable energy consumption decreases the CO2 emissions, and real GDP. In case of real GDP, we can see the real GDP also increases at the first stage. The real GDP increases CO2 emissions, while we have taken the square of the real GDP, and then we tested it. It shows the negative and significant impact. That means the environmental Kuznets curve is existing in these countries. So when the development increase in these countries, the environment can be improved. So the conclusion and the implications. So to sum up our paper, we may say that we have attempted to see the relationship of the globalization, renewable energy consumption, and economic growth on environmental quality in the South Asian countries. We used this data from 19 to 14, and the results, we took the different tests, a unit root test, a CD test, and the second generation unit root test, and the co-integration, 3 types of co-integration tests. After verifying these tests, we also found out, that the FMOLS, the results from the FMOLS and the DOLS explains that globalization in these countries increases CO2 emission, which spoils the environment. However, it decreases this renewable energy consumption, improves the environment, and in terms of economic growth, it increases CO2 emissions in the first stage, and in the later stage it decreases CO2 emissions. So the policy implications, we suggest some of the policies to control the environmental degradation in South Asian countries. The government of these countries should emphasize the manufacturing industries to adopt the modern environmental friendly method of production. Government of these countries also should promote the renewable energies in industries, houses, and transport. Moreover, the green innovations should be promoted through the financial and non-financial government assistance. So the government should also impose the taxes on the non-renewable energy consumption, such as fossil fuels. Moreover, the government also make sure and enforce the strict environmental regulation for the domestic as well as for the foreign investment. In addition, the government of these countries also should make a sustainable development program for the long-term environmental sustainability in these countries. Thank you so much. That was my paper, and if you have any question, I will reply.
Thank you very much for the presentation, for being extra punctual. That is fantastic. We are on time. I would suggest again, all questions either go directly to the author. You can download the paper from our webpage, and there will be also the email of the author, or you can type them now in chat so that the presenter can see them. We now have our next presenter. Wahid, if you stop sharing your screen, the next presenter can start sharing, because we cannot share two at the same time. Nakib Ur Rehman, if I am correctly pronouncing the name.
Yes, thank you very much. You are so good.
Thank you. The floor is yours. You can start sharing your screen.
Okay, let me share my screen. Okay, I hope you can see.
Yes, we can see.
Okay, so let me introduce myself. How much time do I have? I have 15 minutes, I guess.
You have 15 minutes, yeah. For online presentation, we have 15 minutes.
That is always a challenging for us. Okay, I'm Nakib Rahman. I'm senior lecturer at Westminster International University, and I recently finished this paper along with my co-author from Sergio De Stefanis from Italy. This study is all about the employment impact of different forms of investment expenditure across European regions. So this is the structure of my presentation for today. I will talk about the motivation, then literature survey, and then what is the contribution, and followed by some data source and empirical analysis, and then ended up with the policy implications. Actually, as we know that we are going through a fourth industrial revolution, and one question that actually always strikes my mind as a researcher in economics of innovation, whether technologies create jobs or destroy jobs in the labor market. Well, the research has been extensively done in the economic fields, and we come across actually these two indicators: the gross capital stock as an indicator proxy of process innovation that actually destroy jobs, and on the other hand, that is R&D, which is used also product innovation, proxy for product innovation, create jobs in total employment. So this research question led me to investigate actually further in the European regions. And the research context of my study is European regions, not school-level regions. These are the primary regions to receive benefits from the European funding. As we know that the European Lisbon agenda is based on that to increase the level of R&D up to 3% of their GDP should be spent on R&D, and to convert these economies from traditional into a more knowledge-based economies. And they come up with a new programming period actually that started already started from 2021, and it will go until 2027. And you can see that funding would mostly go into European agriculture and development from European social and cohesion funds. So the aim of this funding is actually to make these European economies regionally most competitive and make sure that there must be less disparity between European regions, Eastern Europe, Baltic, and other countries. Okay, the literature is overall scarce, actually, dearth of literature, empirical literature when it comes to the regional level analysis one. So that is the novelty of our paper. And okay, so when we go through the literature, actually, we come across very frequently the compensation mechanism in the literature that actually technologies initially they destroy jobs, but then they create jobs at some point. For example, the classical mechanism, it says actually the new machines, when we invest on new machines, that creates a more, less jobs, but gradually it creates some jobs in other sectors of the economy. So for example, from traditional to most advanced technologies and technological sectors. For example, another reason is that decrease in prices actually leads to lower unit of cost of production, and then actually it again increase the jobs in the market, labor market. The neoclassical mechanism is move around the discussion, move around the decrease in wages actually leads to increase in demand for a labor, and that actually create more job opportunities. And similarly, within the case of Keynesian mechanism, if we, according to Keynesian mechanism, that actually technologies increase growth, income, and that actually subsequently it actually accelerate the consumption in the economy and increase the labor demand in the market. And nonetheless, actually the Schumpeterian mechanism is all about creative destruction, that technologies creates new products and replace the old one, and these new products actually create new markets in the economy and will lead to more jobs. So in other words, actually it's a kind of a very complicated mechanism, and we go further to investigate at micro level and we come across that actually the studies are not consistent when it comes to finding the effect of technologies on the employment when they take into account the sector of the economy. For example, if this study particularly investigated the most developed in a developed economies by using the micro level firms, and the study is more visible across manufacturing firms rather than services firms. Another researcher actually from again on a European Union firms and using the community innovation survey data, and they use actually a proxy patent citation that actually is the output. So again, if we see that the findings are robust across high and medium tech firms, and the effect is lower across low tech firms. So we may say that actually these technologies could be a kind of a skill biased when it comes to creating jobs. They create more skilled jobs and destroy the low skilled jobs in the labor market. And then if we focus on the third studies, actually, again, it's on the 5 European countries, firms. They use the firm level data, and their somewhat their findings are consistent to the previous findings. If we go on my interest is on macro level studies, and if we come across actually there is overall scarce empirical literature at regional level. And we I just here reported some here from very important studies here, and we see that clearly the findings are actually not robust and not very in other words inconsistent. For example, in the first study, actually there is no direct evidence found between R&D and employment. And if we go in the second study, actually the finding is more biased towards more scale and information intensive suppliers. Similarly, the third study also at macro level, they found that actually the innovation creates jobs more in the technological advanced industries in sector 1, and they create more high skilled jobs rather than low skills. So we can say that actually the technologies are skill biased in the labor market one. We use European Union funds. That funds are the combination of European agriculture, social cohesion, and agriculture funds. We use these variables, and we did some literature survey, and we found some very interesting findings here that actually these fundings have a very different impacts when we split Europe into different regions like Eastern Europe, Baltic regions, and Nordic regions one. So mostly the European funds actually positively influence growth and employment across rich regions than the poor regions one. For example, this third study, I mean, if they conducted a study at a third level, administrative level of European Union, and they come across actually the structural funds positively influence growth across German and UK regions instead of Italian and Spanish regions one. So that's what actually the European Union is focusing to divert more funding to the lag regions or peripheral regions that are actually weak regions to influence more growth and job opportunities one.
Nakib, you have 5 more minutes.
Oops. Okay, I need to be, okay, this is my research contribution. No study, as I said, that no study has been found actually to using these 3 simultaneous variable in gross fixed capital, R&D expenditure, and structural funds one. So that is our research question that we're going to examine their effect on the overall employment one. Overall, we use 28 European countries by having 264 regions. You can see that these small countries, Croatia, Cyprus, these are relatively small countries and data is not available. So we treated these small countries as NUTS2 regions. Oops. These are my variables. Very interesting. I mean, actually, the interesting part of our empirical study is we use some conditional factors in our regression analysis one, and these are regional growth competitive, regional competitiveness levels one. And these are actually measured as basic pillar, efficiency, and innovation stage of development pillar one. So we would take, we took these pillars into account while investigating the effect of these 3 variables on employment. This is our model. Actually, we use a very interesting model. Actually, this is a very frequently used in our empirical studies one system GMM. We have a 2 equation, the baseline model and the conditional. When I say the conditional labor demand, that actually we use these regional competitiveness pillars, these 4 pillars. We introduce the interaction of these with the R&D, structural funds, and gross fixed capital formation one. Might be a question in your mind why we have not divided the data or split the data into these type of regions, because when we actually investigated these regional competitive pillars one, and actually these are quite heterogeneous. You can see that the first pillar, basic pillar, is very symmetric. The second one is more negatively skewed one, and the third one you see that it's actually more thick towards tail one, and the fourth pillar, the stage of development, is actually quite different from the 3 ones. So it is not good decision to split the sample into different regions one. Otherwise, we would have a very different results one, not very consistent results one. So these are I'm not going to focus on the initial variables one. Our results, the initial employment, wages, and GDP, these are actually consistent throughout our econometric models and very stable. And so I'm going to focus on the key variables of my interest, actually the capital stock, which is measured as gross fixed capital formation. You can see that actually positively influenced and very strong coefficient. What does that mean? Actually, in these countries, specifically, we may say that actually those regions who are weak, are poor regions, are actually far behind the technological frontier. For them, actually, the capital and employment actually is a complementary relationship one. So we see that when we actually introduce the interactive effects one, you can see that the gross fixed capital formation multiplied with the innovation pillar becomes, the sign become negative one. So this actually outcome suggests that those regions which are closer to the world technological frontier, for them actually gross fixed capital and innovation and employment actually, in other words, the capital stock and employment are a substitution one. Substitution effect means they increase the capital stock one by reducing the labor one for a rich regions one.
I have to ask you to proceed to the main conclusions because there is 1 minute left. I'm sorry.
Okay. So these are the marginal plots one, very interesting one. You can see that R&D works much better when we interact with these pillar ones. The values of R&D increases with the passage of time one. Similarly, we may see that the gross capital formation with the innovation pillar is actually inverse because of the substitution effect between capital stock and labor one. Policy implications, I mean, as you know that the European Union is focusing again on their program 2021 until 2027, that actually strong emphasis should be made on infrastructure and innovative one. And our research actually implies that actually increasing funding structural funds and increasing the capital stock before increasing these innovation technology, it is better to improve the regional structure so that they should take the benefits of these three variables one. Our results implies that actually R&D is needed to create jobs one. So R&D is a labor friendly, not labor saving variable one. So it should be continuously used to drive the lag regions of European Union closer to the world technological frontier one. For example, Eastern Europe and Baltic countries, they are behind the Western regions one. So we have to encourage more innovation in friendly environment. And that is, that the technological readiness, because that comes from this policy implication comes from the innovation pillar one. So they need to have improve their human capital, more business sophistication, so that they should create more job opportunities one.
I'm very sorry, we're over time already.
Okay, just let me conclude. So if the European Structural Investment Fund should be carried out, it should be spending, and the focus should again be on a peripheral regions of European Union one. Future research, as we did not take into account the division of public and private R&D. In future, it could be done to split the R&D into public and private R&D and to see actually integrate this data possibly with the community innovation survey to see whether we have the same findings or not one. And we did not take into account the sectoral disaggregation of the analysis one. So in future, it would be much better to have a sectoral analysis by using the NUTS2 level data one.
Thank you. That's the end because we have the next speaker. If you can stop sharing your screen, the next speaker can start sharing the screen.
Okay, thank you.
The next speaker is Denis Sugaipov, and this is the last presentation for today. Then you have 15 minutes. The floor is yours.
Thank you. Wait a little bit. Can you hear me?
Yes, we can hear you. We can see the slides. Everything is fine.
Good. Good afternoon, dear colleagues. Today I want to present you some information about my current research work, modeling the impact of terms of trade news shocks on the Russian economy. And let us begin with some motivation for our work. So according to macroeconomic theory, cyclical fluctuations are caused by unpredictable events or shocks. And for a long period of time, scientists have tried to analyze these structural shocks that can lead to co-movement between macroeconomic variables. However, it became clear that structural or unanticipated shocks do not lead to the co-movements seen in the data. And then they decided to study the impact of expected shocks on the economy. The idea was simple, that economic agents or individuals can predict future changes in the economy based on the current information, and therefore it has impact on their investment and consumption decisions. So pessimistic and optimistic sentiments can lead to macroeconomic fluctuations. And some research found that economic agents can also predict terms of trade movements. And therefore, it's important for some developing countries, and it can be also important for Russia if economic agents can predict changes in oil prices, for example, and this will lead to this will also lead to improvements in output, consumption, and investment. This research found that new shocks explain high share of variation of macroeconomic indicators in developing countries, but these results vary widely across these economies. It may be because they didn't include some structural shifts in their model that may be important for developing countries. So the purpose of our study is to study the impact of terms of trade news shocks on the dynamics of Russian macroeconomic indicators. And let us move to literature review. We have two main fields that are important for our study. The first one is about the empirical works of news shocks, where the war models were firstly used. The most important here is a paper by Barsky and Sims, where they used a new novel approach to identify news shocks about future productivity. So they emphasize that economic agents can predict future improvements and future innovations, and this can lead to changes in current GDP, consumption, investment, and hours worked. And therefore, they used innovations that can be seen in the data to identify the shocks that explains the most variation of a target variable. For example, it explains the most variation in productivity for some finite horizon in the future. And also, on the other hand, we have there is a literature on the role of terms of trade shocks in developing countries. So some research highlighted that they are important. Others found that unexpected terms of trade explain only a small variation of current output, and therefore maybe the most important here are news shocks. And Ziv and his colleagues found that these shocks are very important for Latin American countries. They explain almost 50% of variation in macroeconomic indicators. So let us move to our maximum forecast error variance approach. Here are on this slide are presented some basics about the vector autoregressive models. So assume that we have a model with some lags, with some observables and some innovations. This is a simple model and it can be more complicated. We can include in this model also a trend and constant terms and also structural shifts. So we can rewrite this model in a moving average representation and find the H step ahead forecast error at some horizon tau. And we can also calculate the contribution to the forecast error variance of some variable, for example, target variable or terms of trade variable, attributable to a news shock at some finite horizon in the future. This finite horizon can be identified from a literature. For example, we know that economic agents expect rise in future prices in 4 quarters or in a year, or we know that economic models have a good prediction power for oil prices for a horizon of 1 year. And therefore, we choose a truncation horizon of 4 quarters. So the identification of news shock requires finding the column of an orthogonal matrix, which accounts for the maximum forecast error variance share at the truncation horizon. And also we include that it is allowed to affect terms of trade movements on impact, because we know that if economic agents are expecting, for example, in the example for Russia, they are expecting a rise in oil prices in the future, they can rise also demand for oil today, and this will lead to increase in terms of trade also today. Therefore, we need to solve the following optimization problems that is presented on the bottom of this slide. So let us move to the data that we used in our research. We used quarterly data for 20 years from 2000 to 2019, and we have in our baseline model 7 variables that are presented on this slide. We also choose a number of lags and maximization horizon according to some information criteria, and a maximization horizon was chosen because of literature review and the predictive power of economic agents in predicting the changes in price of oil. So our results here are presented inputs responses to new terms of trade shock. And as we can see from the slide, in response to the expected shock, the indicators of terms of trade, consumption, investment, and exchange rate rise on impact, and output rises with the lag. These are good results from the theoretical point of view, because we know that if economic agents expect a rise in their earnings in the future, they can rise also their consumption today, and they will smooth consumption over the period. The same picture is the same situation can be with investments, so they start to invest before actual increase in oil prices, and therefore the output rises with the lag. And we can also see that housing prices are affected in a short horizon negative, and then they turn to be out positive. And also we have calculated unanticipated terms of trade shock. Here we used not the forecast error variance maximization approach, we used the Kholetsky decomposition. And we found that most variables are affected in the short term, and this effect consists at a small period of time, only for 5 quarters. For most variables, and housing prices are affected with the lag. So we can say that
we have 4 minutes.
Okay, we can say that anticipated shocks can be more important. So what we can mention. First of all, news shock explains a large share of the macro indicators variation, and on average it explains more variation of indicators than an unexpected shock. And also this significant reaction persists for longer for a news shock in the medium term, up to 10-15 quarters. We also have checked the robustness of our results for a specification without structural shift for different samples, for example, from since 2010. We have varied the forecast horizon for 3-5 quarters and varied the number of lags dependent on the information criteria that we found. And also we have included some additional variables like CPI. So let us briefly analyze the historical decomposition of terms of trade. What we can see that for most period of time, news and unexpected shocks had the same influence on the terms of trade. But there are some periods where news shocks have less impact on the real economy. For example, the periods of crises in Russian economy, for example, in 2008-2009 and from 2014 to 2015. This is because our economic agents making their expectations, they do not include the political or economic crises in their forecasting, in their forecasts. And therefore, they cannot predict such unexpected movements. What concerns the negative impact of terms of trade shocks, they were because people expected the fall in oil prices because of new energy sources that can be found in the that can be implemented in the economy, in the trade. And what concerns some positive influence of terms of trade news shock, it is because our individuals expected the rise in economic activity, for example, in 2011, 2014. So let us make some concluding remarks. First of all, we should mention that terms of trade news shocks have a significant impact on real variables, and they lead to co-directional changes in output, consumption, investment, and the exchange rate. They are also important because they, on average, explain 20% more variation of our macro indicators, and this result is robust, and it's very important for the Russian economy, because maybe the expectations of people lead to changes in economic variables. So anticipated and unanticipated shocks generally behave in a similar way, but they have a number of distinctive features. For example, news shocks, as I mentioned before, at the beginning of the crisis periods, they influenced macroeconomic indicators much weaker. Because economic agents do not include in their forecasts this economic crisis that may happen in the future. So we should. What we could say, we can change the expectations of people. So we should make people forecast more accurately the future changes in oil prices. So thank you for your attention.
Thank you very much. I like to, it links a little bit to the area of my research expectations, and I found the result that expected shocks have more pronounced effects on changes than unexpected. It's quite interesting. I will now turn to the
more time for discussion, but before we move into this discussion, I'd like to thank all the speakers, particularly as well.
The other session is also finishing,
which
and
makes it easy for
just
chairperson.
to have.
But I would open the discussion now if there are questions on any of the talks we had.
You probably can hear them.
We can start with Marcos, who that's still most vividly now on our mind. Are there any questions? Well, Marco, I have one. You may take the privilege of starting early.
Then I can offer also time if they're still asking questions. So if there are any questions in our session, I think I would still appreciate if they are on chat, because that would be easier to track. But if anyone wants to ask a question live, you're welcome.
You'll find it's far from homogeneous, because different companies usually offer quite different contracts, in terms of parameters, of course. It's no longer the electricity price alone, it is the length of the guaranteed price.
Since there are no questions, what I will do, I would just, because I will, instead of sharing screens of both sessions, I would like to thank everyone for taking part in the conference. Thank you for the speakers, for the punctuality that you all kept to the very strict timing. That was very important. And I would like to thank the organizing committee, which on the very last minutes, when the lockdown was introduced, has changed the format, helped me redesign the program. And I would like to also thank all the chairs of the sessions who at the last moment agreed to do it online: Maria Molodchik, Peter Pashakov, but also Laura Brardi, who joined in the very last minute, and Yuri, who is chairing the last session. So I'm concluding our session. Thank you very much. And then I will join to the other session, and we'll also thank the participants over there. If you want to hear this again, feel free to join the stream B. Have a very good day, and I hope to see you all next year in Perm, live. Live. We don't want online conferences anymore. Thank you very much. Bye-bye.
Thank you. Bye.
Thank you.
Bye-bye.
Goodbye.